a lot of people talk about glove, right? Recently, right? I will give this analogy, very simple, right? If now I will give you, I have a proposal. I have this stock. I have my company, right? I'm going to sell you for, okay, I got 1 million profit, for instance. I'm going to offer to sell for 4 million. I'm just going to have 4 times PE.
Yeah.
But there is a caveat. I'm just telling you, next year or 2 years down the road, the profit will drop. But I don't know how much it will drop.
Okay.
Maybe it's dropped 500,000, it may drop 100,000, or it may go on to negative. I don't know. But now I'm willing to sell you at 4 million for my business. Now, will you be willing to buy it?
Most people won't, I think.
Exactly right. See, now I can understand. That's the same situation faced in the glove.
Sentiment, in a way, for lack of a better word, follow through.
No, but what I'm hearing is that you're saying in year 2, the glove companies will not be as profitable, or there's a chance.
No, because you see, like it or not, right? Demand will normalize. Normalize is not fall.
Yeah. Go back to the old
pre-COVID lah.
Correct. Growth will still be there, but the growth won't be as strong as during this period. Right?
Of course, yeah.
So then boils down, for those who run business, you know, as the $1 million question, can the current average selling price hold for the next 2-3 years?
Right.
Right? It's only a matter of time before ASP will have to readjust itself.
Yeah.
Or the average selling price.
Reversion to the mean.
Before we begin the podcast, have you gotten your free ebook? It's called the Build a Six-Figure Portfolio Guidebook. Now, inside it, we share with you the tips and tricks to bring your stock investing skills to the next level. The best part, it's only 10 pages long and it's totally free. Whether you're on Spotify or YouTube, the link to download is in the description, or you can go to www.firl.co/FREE or www.firl.co/free. Okay, everyone. Welcome back to the FIRL Podcast, best place for long-term stock investors. Now, today is a guest that we have anticipated for quite a while. We actually wanted to get him a lot earlier, but due to certain complications, we cannot. But finally, we now have the guest that we've been looking for. Now, let me do a brief introduction, right? So, this person that we're going to talk to today is a former fund manager. So the real one, right? Not the gurus like us, the real one. Nah, just kidding. The real one. And he's also...
Got license.
Yeah, got license one. So he's a former fund manager. And he does not wish to become a fund manager anymore. At least that's what he told me before the podcast. Yeah. He's also an author, right? So if you've been looking through like online, I think they run ads, and not the company, but bookstore companies run ads on some of the books, and it's a top seller on MPH, right?
Yeah.
It is called What I Learned as an Analyst. Right. So this book, the author, we have him here today.
Yeah.
He's also the founder of Trident Analytics, which is currently an independent research company, and that is his project right now. We'll talk a little bit about it later in the podcast. But welcome to the podcast, Mr. Peter Lim.
Yeah, thanks, MJ.
It's
yeah.
And yeah, actually, I just want to extend a little bit, right? Because I said former fund manager, so I just want to shout out your pedigree a little bit, lah.
Yeah.
Just to,
Yeah, have to.
okay, so he started his career at Capital Dynamics Group as an analyst, and I think this is the longest job you had. This is the longest, right? I mean, almost 5.5 years from 2003 to 2008. And to give you an idea what it means to be an analyst at Capital Dynamics, it is one of the most rigorous, I would say, program out there. I would call it a program because it's a learning process out there for anyone who wants to become an analyst.
It's like the Navy SEALs boot camp.
Navy SEALs for Malaysian stock investing. Yeah. So if you are an analyst coming out of Capital Dynamics, even if you are the worst one, even if you're only there for 6 months, people know that at least you've got some pretty good analytical skills, right? And so I don't know if this is true. I don't know if you can even review this, but I believe you are the longest lasting analyst there in history, maybe?
At the point when I left, yes.
At the point when I left, okay.
Updated for.
So you still hold the record, a Guinness record for being the longest there.
I'm not sure.
Yeah. But yeah, it's a great and tough place to be, and certainly Peter was one of the diamonds there, right? Then after he moved on to head of research for Corson Smith, and then fund manager for UOB Asset Management, then Manulife, fund manager as well, Head of Equity Fund Manager as well for RHB Asset Management, CEO of Interpacific Asset Management, and then after that, he joined the company that all three of us was part of, and that's actually how
we met. Yeah.
And so, yeah, that is the pedigree of the person we're talking about today. I hope I didn't do too bad with that. Right? So, I mean, as usual, and you know, he's also a big fan of charity.
Yes.
I forgot to tell you, he goes to work in a scooter.
Oh yeah.
I think you give 80% of your income.
Not 80%, but double digits.
Double digits.
digit.
Okay, good enough.
Better than a lot of people, right?
Better than a lot of people. Yeah. So we'll talk about charity, all of that later on. But I want to start with a basic question, right? And that is, what got you into investing? And when was the time you realized, hey, I gotta be an investor? And specifically, what got you into stock investing?
Oh, I think it's quite ironic. It's actually by accident, right?
Share with us the story. Enlighten us.
I graduated from accountancy way back in 2003, right? As with others, I go into audit firm.
Oh.
Right?
How long did it last?
Okay. On my first day of work, in the first 10 minutes, I regretted my decision.
Okay.
So what happened during minute 1 and 9? What was happening?
Oh, well, I was being quite a problematic person to a certain extent. No,
Okay.
everybody aimed for top 4.
Yeah.
I actually declined the top 4 audit.
Wow.
Yeah, so I actually choose the number 5.
Okay.
Deliberately, right?
Solid.
So on my first day, that was actually my first official job.
Okay.
I started working in factories when I was 13 to a certain extent.
Okay.
But
Child labor, that's child labor, doesn't really count.
since it's past now, I don't think they'll catch me for what happened historically. Yeah. So when I step into the building, right? I mean, you expect people to there's a HR come and say, okay, let's do an orientation. Let me introduce your colleague. This is your workplace. Not really. No, when I step in the first 10 minutes, the HR came, said, okay, we are going to subcon you to Shell.
Wow.
Oh,
And off I go immediately. No, I only stepped into my office in the first 10 minutes.
I see. Okay.
Okay, shit, I made a mistake.
Yeah.
So that was 2003, right? So there's no high-speed internet.
Okay.
And even internet was actually a luxury, to be very honest.
Mm.
We're all students there in 2003, right? So we still find jobs using classified ads. We buy newspapers, and it was quite thick at the time, so you actually flip one by one.
Okay.
To show the desperation of how much I will get of audit, I actually applied for anything.
Oh.
I applied for human resource, I applied for marketing.
Wow.
Anything that can get me out of audit, right? So then came this very small article about this company called iCapital. So I just apply. I don't really know what is it, right? So and that time you apply not through emails. You really print
Mail.
out
Snail mail.
snail mail, and in the hard copy, right? But it was quite fast. I think within 3 days I got a call for interview. I said, okay, let's go for interview. So in the first interview I sat there. So I still remember the first 2 questions they asked me. They said, have you heard about us? I said no.
Nice.
Yeah.
Okay.
Do you know what we do? I said no.
I think.
No, there's no internet.
Yeah, I think today is unforgivable.
That time there's still no internet. So, they still can accept. So somehow luckily I got the job, and that's how I started becoming an analyst. It was never intentional. There's no aspiration. Okay, I want to be a fund manager. I want to be an analyst. So it's just purely by accident.
Okay.
Right. So in those early years, right, what do you learn from that? Because of course, it is the earlier you are in your career, the more you learn, the more you are shaped, which leads you to be who you are today. And so in those 5.5 years, right, what are some of the key lessons that, even up to today, you still share with us, anyone listening, that you would say is really positive and you should adopt the same kind of skills, mindset, whatever it is?
I'll say patience, right? When I joined Capital Dynamics, in the first 6 months, I actually spent my first 6 months just reading. Just reading. I was so frustrated, I actually resigned.
Oh,
I actually resigned. So my point is, I actually went to my boss that time and said, why are you hiring me, paying me monthly salary when I got nothing to do?
Just reading.
Just reading. So every day I would just go to they have an internal library there. So I just pick up business magazines, fortunes. I just read. Every day, just imagine go to office, just read, and see all your colleagues, they are all busy working, right? You really got nothing to do. you just spend the whole day reading. I was like, you feel so worthless, right? So after 6 months, I said, okay, enough is enough. So I actually resigned. I did resign, right? So that time was 1 month notice. So it was only until last week I started thinking myself. I said, maybe I should prove myself that I can actually be an analyst, right? So on the last week, I actually went back to him. I said, can I retract my resignation?
What did he say?
Good. Okay, and that's it.
Right.
And it's like back to work normal. Actually, that intention was just to prove that, I can be an analyst. I'm not as worthless as I thought I am or I'm supposed to be. It was only further down, I think after a few years, can't remember exactly when, then I know the conversation came about, right? Then only then he explained why or why that incident happened. He said, as an analyst, you're supposed to read widely. And if you're already reading widely at that point in time, why should I stop you?
I see.
Then it was only that time I said, okay. so it's only at the time that he revealed why I spent the first 6 months reading, because that was supposed to be. So as an analyst, you have to be patient. Second is you really have to read very widely.
So in that 6 months, then right after you retracted, then straight away you can start writing reports, or another 6 months of reading?
No. Actually, I did get involved very, very little. But after that, technically, I get more involved in doing research in that sense.
Right. Okay. So that was very early on, and as you progress, because that's technically speaking, that's like your only analyst job. After that was all fund manager, head of research, really, right?
Yes and no.
Okay.
For me, my style is, even as a fund manager, my style is I will only invest things that I know or that I understand.
Right.
So you actually roll up your sleeve and do the work.
You have to. I mean, even then, you have analysts working for you. I mean, of course, they will brief you about certain companies, right? But then, if I'm really interested, I will still go down to really understand myself.
Right.
So to me, managing funds and research is something that we cannot separate.
Right.
It goes hand in hand.
Goes hand in hand. But unfortunately, in the market, it's really being separated. Right? You have analysts that's doing the research. You have the fund managers that's going to rely on the analyst call to actually decide whether to buy or to sell.
Right. So now, so since 2003, right? So now it's like what, 18 years of investing already, basically. And how would you describe your investing style / philosophy, and how has it developed? Has it changed, or has it been pretty much the same all this while?
I give a side. See, I'm always trying to avoid use the word value investing.
Sure.
Because value investing is a very overused word. Very, very overused.
Means many things to many different people.
Exactly. I think recently Charlie Munger put it in the most aptly. I'm not sure you read in the very recent. He made a fantastic description of what value investing is. And this, according to Charlie Munger, is that the reality is every investor are practicing value investing. The only difference is some sees value in a good company and some sees value in a lousy company.
Okay. That's a very and ironically, it's because it's been so used until it's abused. It is.
I mean, you look at all interviews with all fund managers. I mean, look, those are my peers, right? I mean, when sometimes obviously they are traders.
Yes.
Yeah. It's not about right or wrong, but they're methodology traders.
Different styles only, man.
But when they're interviewed by the media, I'm a long-term investor. It's so convenient, right? Everybody is a value investor, right? You have never written a professional fund manager who came on media and say, I'm a trader.
No one.
Sounds very amateurish. Right?
I'm a value investor. Right? So I'll say more on, if I really use a term, I'll call it more of business-centric. In the sense, I focus more on what is the nature of the business, whether is it sustainable, whether ultimately as an investor, I always say you're actually owning a business. You're not actually buying a share.
Yep.
So the $1 million question is this a business that you really want to own? Or you really want to invest to do within the future? So if I were really to describe the approach, I would say it's really a business-centric approach.
Right. So, I mean, there's a bit of a discussion now, and it's somewhat related to what you talked about value investing on it. So I want to get your thoughts on value and growth, because these are very popular terms, and you are from the fund management industry. And maybe you've managed some of these value funds or growth funds.
There's
or
one more.
income funds.
Dividend.
Income funds.
Yeah, income.
Things like that, right? So, do these terms make any sense to you as in your own words, a business-centric investor?
Honestly, no.
Okay.
So of the three, which is the worst one?
Yeah, which is the one?
You see, how do you actually define? You see, I always make this. I make this argument with a friend before, right? I mean, I say, okay. I mean, he was actually saying, okay, he was actually he was explaining to me his portfolio strategy. He said,
okay,
a certain part of my portfolio is for value. A certain part of my portfolio is for growth. A certain part is for dividend.
Yes.
So then I asked him this question. Okay, when you go for growth, what makes you make the decision to invest in this growth company? See, when it comes to it, ultimately the fundamental bottom line is undervalued. Correct? When you go for value strategy, what is the underlying concept that allows you to pay? It's undervalued. When you go for dividend, why do you invest in this dividend stock and not the other stock? It's undervalued.
Yeah.
So despite all the fancy names you go around, I'm a value investor, I'm a growth investor, I'm a dividend investor, the fundamental methodology that you use is the justification of what invested is undervalued.
Right.
So okay, good.
So
No, we are aligned to that.
we will talk a little bit more about how do you tell if something's undervalued later on.
Yeah.
But I just want to move slightly different to a slightly different path now and ask you, right? So as a professional, essentially, having represented institutions before, one question people ask, especially in the Malaysian market, is that does the retail investor actually have a chance? You know, when institutions have all the leverage that they have, they can meet management, they have Bloomberg terminals and
Yeah.
all of that.
Access to information.
Access to information. So do you think that retailers should even bother trying, given that there's quote unquote so much advantages for institutions?
There are. I think the most common misperception
Mm.
that as an investor, I won't say even say for retail or professional, you need to buy a lot of stocks to be successful in the portfolio. I think that's the biggest issue now. I've been telling people in reality, right? If you really look at, let's take Benjamin Graham for instance, right? Despite his track record, there's only one stock that actually outperforms one single stock that the return surpassed his entire portfolio in all his career. Only one.
I believe it's Geico, right?
Exactly.
Yeah.
So that's the reality, right? So likewise, I've met a lot of successful retail investors. I mean, these are maybe from a few million portfolio to hundreds of million portfolios.
correct.
Right? But of course, in long term, 5 to 10 years, 20 years, right? And when I was discussing with their portfolio, the reality is the whole bulk of the wealth is coming from less than 5 companies.
So those companies, those 1 or 2 companies, were the ones that gave them the multiple baggers, that
Exactly.
concentration.
And these are the companies. The common characteristic of these companies are they are in the these are the companies which they understand very well. The biggest challenge for investors, be it professionals or even retailers, is imagine it's a very common thing, right? You have bankers who know the finance industries, but somehow they like to invest in biomedical, which they know. You have the doctors which know very well about the medical. They like to invest in banking and finance, cryptocurrencies, and which they know nothing about.
Yeah.
Right. So why don't you invest in something you know about? Concentrate, and that's it.
So, but my retort to that would be, okay, so yes, out of however many stocks they buy, 5 did the best, right? But that predicates on them actually investing maybe 20 to 30 stocks. I don't know, is it true for the retail investors that you see, or they actually pick those 5 to 6 stocks only and they all do well?
Yep.
Or they buy a basket and then those 5 did really well and overtook, a bit like Ben Graham's story.
Or maybe,
which is the scenario.
Maybe I think we angle the question this way. Out of, let's just say, an average of 10 stocks, how many do they get right most of the time that have that multiple bagger, a ratio of,
Quite a mix.
Okay.
There are some of them are actually very concentrated. They only have less than 5, and
Okay.
this did very well for them. Some of them is a portfolio of 10 to 20, and maybe 5 of them did very well.
Okay.
It's quite a mix.
Okay.
Mixed bag of results in that sense, right? But see, I'm not against diversification.
Sure.
But
Yeah.
my point of diversification is, if you absolutely don't know what you're doing,
Okay.
please diversify. But if you're absolutely sure of what you're doing, please concentrate.
Because the question MJ and I we get asked a lot is they don't know where to start, especially their circle of competence. Let's say some of them are housewives, so they're not in a professional environment where there's an industry that they can keep track of. Then for them, how do they know what industries to focus on and how many should they actually pick up in a way? Let's just say, for example, let's say a housewife.
Don't underestimate housewives.
Oh, for sure.
Their
My
level,
wife-
their
my-
level of information, right? They will know exactly what's the price of toilet roll. Has it increased or not, right? And there's a listed company in Malaysia that does toilet.
Yeah.
Yeah.
You know, all your washing dishes.
Yes.
It's part of a global. What's the price of Milo that's been going up? Right?
Yeah.
Are you consuming more Milo in your households? Maybe last year you only bought 1 pack, then lasts for a month. See, these are all information, right?
Very good.
So rather than they go and try to go for next big thing, right? Or
Yeah.
let's go to a biotech or some cryptocurrency, which they say, what? Focus on this, right? You have readily available information.
Yes.
What's
yes.
happening there?
Great, because I'm the housewife. I buy the groceries now.
Me too. No, after MCO, all guys became the
Housewives.
But you're still not married, so you wouldn't
I
understand.
wouldn't.
Yeah,
I
no,
wouldn't
but
know.
it's a good because it's a good thing because I think a lot of the people that MJ and I come in touch with in our community, they always have this lack of confidence because I think the finance industry in a way has been trying to sell them this story, sad to say, that you may not be as proficient as managing money as compared to us, and that's the
With no offense to accountants, I'm a chartered accountant.
yeah.
You see, I always joke about this, right? Why it makes accounting so complicated is to justify our fees. So
You
likewise,
heard it here first, everyone.
Here first, guys, from a licensed fund manager and a
Yeah.
chartered accountant.
Not we say one.
so likewise, right?
Yeah.
Investment fund managers, they'll make things very complicated. So complicated that, hey guys, forget about it. Right? Let's pass your money to us. We handle it for you.
Yeah.
Right?
Right,
Great,
yeah.
great. I think I'm really heartened by you saying that, because one of the aims of our podcast is to encourage more people to understand, to take ownership of their own money.
Yeah.
lah.
So,
Yeah.
so those people, those retail investors, you say with tens of millions, 100 millions, right? Does patience play a role in how they invest?
Oh, okay. Before I go into patience, right? Ultimately, the one thing that a lot of investors, the step that they always skip before they started investing is a very basic question: what's your objective? That actually determines everything. Let's say, for instance, maybe your objective is this year I want to make 10% return.
Okay.
Maybe for John, he said, oh, I'm more aggressive. I want 20% return. It's nothing not about wrong or right, right? It's your 10 and your 20. So once you got your objective right,
Okay.
then you will invest based on meeting your objective.
Okay.
Say, for example, if this year, suddenly MJ, you receive 12% return, you have surpassed your 10%, right? But you should be very happy. I've met my... The biggest problem with investors is they start to look around. They start to look at John. John did 20% return because he invested in another company. And that's where all the problem starts. You get very, rather than being satisfied that, hey, I've met my objective, you get very upset. Why did I invest in this company and why not I don't follow John invest in this company? Therefore, he get 20%, I only get 12%.
Right.
Right? So set the objective. What is your objective? So invest based on your objective. You can say you actually clear off a lot of unhappiness and a lot of unnecessary things.
Great. Just to dig, it's a great point, but a lot of times people don't know what's the benchmark. So
What's your objective?
Yeah.
What do you think is a reasonable objective for people? And then also, so 3 questions: your objective. What do you think is a reasonable objective for most people? And the third question is, what is the difference in terms of activity, skill set, or that between, let's say, 10% a year and 20% a year?
Yeah.
Let's be very realistic, right? Whenever people ask what is the reasonable, that's for Malaysian market, what is reasonable long-term annual return? Say long-term means 10 years, 15 years, 20 years. What is the reasonable annual return in Malaysia? I usually guide if you are able to get 8 to 10% per annum, it's actually very, very good. Because if you look at KLCI, the long-term KLCI is only around 6 to 7%.
It's been flat for the past 6 to 7 years already. I think.
But if you come for last 30 years, I can say 1987, right? I think it's around 6 to 7%. So now I can understand why a lot of fund houses, right, when they put their benchmark, they put 6 to 7%. Because that is actually where the KLCI is.
Right.
So if you put more effort, I say, well, getting 8 to 10%, I think that's a very reasonable goal. You make a very good point, right? How much return? Then again, it must be reasonable.
Right.
Look, even Warren Buffett, right, for the last 30, 40 years, he's around 20% per annum.
Yeah, but prior to that, when his fund was small, it was about 40%.
Right.
Yeah.
And the best investor is getting 20% per annum in the long period of time.
Correct.
Then you sure met if some investors saying, I want 50% return per annum.
Sure.
Cam,
Jim Simons, quant, be a quant.
No, whenever I do meet a lot of people who come and tell me, hey, I know my annual return is around 80%. I do make 80%, 100% return. Then there's only 2 possibilities, right?
Yeah.
First thing is his investment horizon is very short. Means either he's in the first year, second year, or maximum 3 years.
Yeah.
Second is he's lying to you.
Right. Also,
Only
so
two
in your
possibilities, right?
view,
Yeah.
3 is short. 3 years is short. You would
3 is
consider.
short because a cycle.
I see.
To really go through the whole cycle, right? You need at least 5 to 7 years. Then you can really feel the whole up cycle and the down cycle.
I think that's a
last year-
very great point.
Yeah, like 2020, right? I said when the tech comes, all shit floats.
Yeah.
Last year, everybody can be a market genius.
Yeah,
Yeah,
true.
Either a glove genius or tech genius.
Alright. Okay, so what is your? I mean, just going back. So you answered the first question, which is what's a reasonable rate of return? What is your rate of return? So rather, what's your expected or objective when it comes to rate of return? And what is the difference between a 10% fund manager and investor and a 20% investor? What does it take to go from one to the other?
Okay. My personal return, I would say my personal aim, right? If
Yeah.
I can achieve 12% per annum, I'm quite happy.
Okay.
Right. What it takes to bring from a 10 to 20.
Yes.
Skill sets, experience, and whatever. What in your opinion?
First thing is you must really it has to be a concentrated portfolio.
Okay.
It has to be a concentrated. And second thing is you must really know it very, very well. That is really, really possible.
So concentration is very interesting question, right? And there's so many questions to go on, but thanks for bringing this up, which is what is concentration? Because I speak to some people before, they said 10 is not concentrated, right? 5 is. But then I think if you talk to the typical fund manager, you say 10, they might get sacked if they just invest in 10 companies. So what is concentration actually?
Okay. You look at unit trust, right?
Yeah.
Unit trust is guided by the SC requirement.
Okay.
SC guideline says on every single fund, on a per fund basis, right? You cannot invest more than 10% in a single stock. And if it's a group of companies, you cannot invest more than 15% in a single fund in a group of companies.
So that means if there's a few that is like holding each other, like holding,
Oh.
yeah, then it cannot exceed 15%.
15%.
Okay.
But in reality, you look at fund managers for unit trust, usually for them, you notice they rarely hit more than 3%. In
That's
the
true.
definition of fund management, right, or the unit trust, right, per se, right, 3% is considered high.
Why? Why
Wow.
3%? Is there a magic number? Is there a
It's
calculation?
just how the cookie crumbles, is that
Yeah.
right? It's just how the thing evaluates.
Yeah, it's just like when you look at your seniors, how seniors doing it, you say, oh, my maximum is 3%, then it somehow set that trend.
Okay.
So now you can roughly understand why, on average, all portfolios in unit trust, you have 30 to 50 stocks.
That's right.
Yeah, it's quite a lot.
Actually,
yeah.
because of this magic number, right?
I see.
There's really no justification behind this 3%.
I see.
Per se. It's more like, we call it industry practice.
I see.
Right.
I call it, I'm a more a thorn in the industry. I call it's a practice to safeguard your job.
Understand. CYA practice.
Yes. Because if you go 3%, if you screw up, well, it's only 3%.
Yeah. True.
So
true.
would you be fair to say, based on what you're saying, I think if you have a portfolio that's less than 20, that can be considered concentrated, because less than 20 would mean about 5% at least.
Then again, it also depends on, are you managing your own money or are you managing for others?
Right. Good point.
If it's your own money, if you really think about it, right? Let's say if it's your own money, so if you really know this company very, very well, right, you're very, very certain. Let's say you won't be 100%. So you're 80% certain about the prospect, the industry in the right. Wouldn't you invest all your money into one stock?
Yeah, logically.
Right?
Yep.
So, yeah, I mean, would there be a need of, okay, the disclaimer is there, that you know it very well. Not because of hearsay, rumor, or or
second hand.
not because your broker said, this is going to be the best stock, this is going to be, just follow. Not that, right? Yeah. But if it's utmost certainty that you done your own research, you done homework, industry you're very familiar with, why diversify? Right?
Yeah.
So again, it really depends. There's really no magic number of how high is high and how low is low. But when I was managing funds, even unit trust, I tend to be a bad boy in the industry. I usually go up to 7 to 8% in the single stock. I mean,
What a bad boy.
Bad boy rap.
Also for stocks which I'm really, really confident, but on basis where I'm really, really confident, I can go up to 7 to 8%.
Okay. Is the fund size actually also a determining criteria on how concentrated it is, or it doesn't?
Basically, the amount of money you manage. Right?
Yeah.
It is. You see, if a fund is smaller, right, look at fund industry again. The fund industry, right? How small is small and how big is big.
Yeah.
Generally, if your fund is below 10 million on the whole, it's quite a small size, and it's very flexible because like even 3% is quite a small number on that per se.
Okay.
Big fund is usually above 10 million, or once it hit around 50 million, right? That's why it's quite sizable in that sense.
I see. What's the sweet spot for you? I mean, if you were given, I know you said you don't want to be a fund manager anymore, but if you're given a fund that you have a free hand to run, what would be a sweet spot for you in terms of size?
On a per fund basis, right? I would say a sweet spot is around 100 million.
100 million.
100 million.
For the Malaysian market.
For the Malaysian market. Because, this is an interesting statistic, right? If you look at the Malaysian market, I think we've got 900, close to 900.
Oh, close to 1,000.
1,000 stocks, right?
Yeah. Plus leap lah.
Okay, if you plus leap.
Yeah,
fine.
yeah.
So if you take the total market cap, right, you combine the whole market cap of these 1,000 companies, you divide by 1,000 companies. Do you know what's the average market cap?
I think it's 1 trillion for the whole market cap right now. Am I right to say?
Plus, yeah, around
1 trillion divided by 1,000. So it's about, my math not so good lah, but 10 million?
10 million?
100 million?
No, not that small.
100 million?
We have surpassed 1 trillion. The last I count was on average, our average market cap in ringgit is around 200 million to 300 million per counter.
Okay.
Which is actually very small.
Yep.
It's very, very small. So what it actually says is that Malaysian stock market is actually, we are dominated by small caps.
I see.
Because, under definition for SC, right? A small cap company is your market cap is below 750 million.
Okay.
That is small cap. So can you imagine when you divide the average we are 300 million.
And it's lower.
It's
Yeah,
lower.
yeah, logically.
Yeah.
So we are a market where it's quite dominated by small caps. I mean, whether
Yeah.
you like it or not, right? That means if your fund size say cross 500 billion, see, we can, okay, usually you perform better by investing in small caps in Malaysia. That's the nature. That's the small cap industry. But once your fund reaches 500 million or half a billion, you're not that flexible because there are a lot of small caps which you may like it, but you're not able to buy it.
Because of your mandate and everything.
Because your fund is so it's big, it's big. Even if I buy 1%, 1% of the half a billion fund is 5 million ringgit.
Yeah, yeah.
Imagine buy 500 million ringgit worth in say a 200 million market cap.
Yeah. And that's 200 million, the whole market cap, but the free float is only, let's say, 20%. It's even smaller, actually.
Yes.
Yeah.
Right.
Yeah.
That's it for Malaysia. I think 100 million is quite a sweet spot.
Okay.
On a per fund basis.
Okay. If it's a global mandate, what do you think what would be a perfect size for you?
Global, I would say also, I think if you can have a 100 million ringgit, which is around 25 million US dollars, I think that would be quite comfortable.
Okay.
Yeah.
Okay. Nice.
Okay. Sorry to interrupt this podcast. I know it's a little bit annoying, but I want to tell you something that I think can be really helpful to you. I can tell you're really interested in the stock market and want to learn more about it so that you actually know what you're doing, especially when today things are getting more complex and complicated. That's why we came up with the Stock Investing Blueprint, or SIB. It's our signature e-learning program that teaches you how to pick the right stocks most of the time, buy and sell it at the best possible time, and manage your stock portfolio systematically. It currently has more than 10 hours of content and it's growing. You'll also be part of a group of like-minded investors that can help speed up your learning process. To hop on the program, click on the link in the description or go to learn.firl.co/courses/SIB. So, I mean, just now you going back to diversification, right? You said that if you're confident, then don't diversify. So you've explained really well about the diversification part, but now I want to discuss more about, okay, what does confidence actually mean, right? Is it looking at the accounting numbers and saying, this is a good company? Or is it looking at some more invisible things like, pricing power and modes and all these things? So where do you sit in that discussion?
Analysis is actually much more than numbers. Actually, looking at historical number or looking at historical data, to a certain extent, it only forms maximum maybe 1/4 of your investment decision.
Okay.
Right. The other plus minus, I mean, 1/4. The other 1/4 actually comes from how well you understand the business. What's the industry dynamics? Like what you mentioned, like the Porter's 5 forces of competition.
Right.
I think that actually what's very interesting in capital dynamics or iCapital, we actually focus more on the 5 forces
Oh,
Really?
rather than the financial numbers. Yes,
Right, okay.
because you want to know how sustainable is this business.
Okay.
The 5 forces analysis actually allows you to understand whether how strong is this company in its positioning. The other 1/4 is the quality of management. Ultimately, are these guys you can trust, right? Or are they people you just wouldn't trust them? Because see, ultimately, as an investor, you're not running the company.
Yeah.
These are the guys who are running company 24 hours a day,
Yes.
right? So if they are the guys you can't trust, so why invest in them?
In a way, you're going to bed with them in a way.
Yeah, that's right.
Yeah.
And the last 1/4 is really the valuation. You can have a company that fulfills all the first 3 criteria. The historical financial data is fantastic. The quality of management is very, very good. The business is love it. But sometimes the price is just way too high. Say for instance, 100 times PE.
Okay.
Right. So financial is only like plus minus only 1/4 of your decision.
An important quarter, but still a quarter.
It's still a quarter. So if you really look at it to a certain extent, right? Do you notice 75% or 3/4 are actually qualitative aspect.
Yeah.
Only 1/4 is quantitative aspect.
Great. Just to write on that point about qualitative, besides Porter's 5 forces, right? What other things would you advise an investor to strengthen their qualitative analysis besides reading the annual reports?
And also, what about Porter's 5 forces that you find to be very useful in your own words to discover the sustainability for a company?
See, always, let's say, back to the diversification part, right?
Yeah.
See, always starts with what industry you know best. See, every working person, they must be working in a certain industry.
Yeah.
And they're exposed to that industry day in, day out. So always start with the industry that give you an edge. Right? See, it doesn't mean that you can only make money in tech stocks or you can only make money in glove stocks. right? I've seen people making money in pharmaceutical stocks. I've seen people make money in all industries. There are opportunities to make a decent return out of it. So always starts from there.
I see.
Yeah. So your second question.
So I mean, second one was about what, because you mentioned when you at Capital Dynamics, you guys focus a lot on Michael Porter's 5 forces, right? So my question would be, what about those 5 forces that you use even up to this day to discover sustainability in a company and your overall qualitative analysis?
Actually, it's very simple. Like say, for instance, whenever you go for any company visits, right?
Mm.
People always focus what's your revenue, what's your revenue, what's your revenue.
Right, right.
But people forgot a very basic question: who determines the pricing of the product? It's a very basic question,
Yeah.
but it's a very important question. So ultimately, who has that pricing power? The best you can find is if a company said, I set the price of my product. That is what you're looking for. But unfortunately, there's a lot of businesses where they don't have that pricing power. The pricing power is either regulated by the government or it's too competitive. It's determined by the level of competition in the market.
So the supply and demand forces of the market.
So would you say that people should avoid investing in companies where the management or the company don't determine the price of their product, or there's still room to do it?
You see, when you run the business, right, you just on a very broadly basis, right, there are 2 elements that you must be able to control either one. Either you must be able to control your selling price, or you must be able to control your cost. So if you are in a business where you can't control your selling price, you must be able to control your cost. Right? If you're in a business where you can't control your cost, you must be able to control your selling price. Of course, the blue sky scenario is if you find a business that controls both.
Wow.
Both
Of
selling
course.
price and my cost.
Yeah.
And the worst case scenario is you find a company you can't control your selling price, you can control your cost. Right. So these are very basic qualitative aspects.
Yeah.
Right. And these are actually, look at Porter's, right? What is the level of competition? Who has the pricing power? The bargaining power of supplier? The bargaining power of customers? So it's very qualitative. But it's a very simple question.
But it's very profound.
But it's very important.
Yeah. But on that same note, right? Besides having that information when you visit or you have access to management, how else can a retail investor, based on public information, how else would the retail investor be able to get that kind of data or insights?
See, I always like to invest in consumer and manufacturing related. That's always been where my focus is. Right? I rarely invest in things I can't see.
I see.
Right? Those anything to do with digital, I'm quite bad, right? Because you cannot feel it.
Yeah.
And why I focus on manufacturing and consumer is things you can see. You can observe because there's a raw material, there's a production, there's an output.
Right.
So there is something you can monitor, which you can actually look at it, right? There was one. This is all purely observation, right? That stick we all drive on the road most of the time.
Yeah.
Do anyone actually take the trouble to look at how many cars? While you're stuck in traffic jam, rather than complain about traffic, just take a note and look left and right. What car that you see the most? I still remember this way back. I think in 2011, 2012. I still remember then Tanchong Nissan launched the Almera.
Oh yes.
Way back then, right?
Yes.
So I take my scooter there, right? So I noticed I seems to bump into a lot of Almera on the road. Right? So quite interesting. So that actually prompted me to actually look. Hey, maybe I should look at Tanchong and look at the numbers, right? That time it really caught me by surprise. Those are those back then numbers. 2012, right? See, in 2011, 2012, the best selling car is Vios. And Vios that time you're talking about average 3,000 to 4,000 units a month.
Yep.
City was the second best selling, around 2,000 to 3,000 a month. Right? These are way back 2011, 2012 numbers. Right?
Yeah.
Almera, after I did my check, they actually crossed 2,000 over a month.
Wow.
Which
So
is quite
top 3.
significant.
So
Quite
it start from nowhere, right?
Because you see, can you remember what was car
It
before Almera?
says no. In the C segment, for that segment, Nissan had nothing to compete.
Exactly.
Yeah.
So it was like, wow. So I actually invested in Tanchong. And true enough, the numbers was really driven in the subsequent quarters, right? The Almera really drove the numbers. And you see, these are not some rocket science. This is just purely
Observation.
rather than cursing on the road on
LDP,
jam,
you just see
what cars you see on the road.
LDP analysis. It's a new type of analysis.
It's surprising. I did the same for UMW. That was way back in 2012, 2013 when they launched a new Camry. I used the same method. I just noticed, there's quite a lot of Camry on the road.
Actually, you know the car you used to drive, Peter, the CX-5? Because I own a CX-5 as well, right? I was shocked because I went to the service center and I asked them, last time, how many, the salesperson was telling me, prior to this CKD version, they used to sell 30 units and then they used to sell 100 per week. It's crazy, but I didn't take advantage of it. Too bad. So now
you see, there's no rocket science in this.
Yeah.
This is just purely observation. Look, I'm not even an auto car guy. I don't work in UMW. I don't work in Tanchong. But
Yeah.
it's just some very common thing. Which if you just take the trouble rather than just see things,
Yeah.
but you observe and put some thoughts into it,
Yeah.
you actually
Right.
give some idea of what is the next trend that you should be looking at.
So Proton.
Proton is under DRB, but see, unfortunately,
Yeah.
the whole Proton is a very small proportion of DRB.
Mm.
So even if Proton
Ah.
were to turn around,
Yeah.
it would have much impact on DRB.
Unless you could buy a Proton stock, which we don't have.
Yeah, we
but-
should.
Yeah.
Too bad.
Okay, so you broke down very interesting in terms of your process of thinking about investing into 4 broad segments. So I think you shared with us a lot about the second segment, which is the mode Porter's 5 forces analysis. So let's go back one step, which is the accounting numbers. Now, of course, 3 quarters are qualitative, but this quantitative still takes up 25%, right? So what do you see? What are some of the key metrics that you see from a quantitative basis? You're like, okay, good, this is a good company or something worth considering.
The first thing I always look at is actually the cash flow,
Mm.
the operation cash flow. So
Mm.
what I look for is a company with, consistent positive operating cash flow.
Mm.
Mean to say at least 80% of the time, the operating cash flow must be positive.
Mm.
It doesn't mean it must be on a growing trend.
Mm.
I think I have yet to see a company where consistently the operating cash flow is on.
Wow. Why is that? Why is that? the
Why is
case?
that the case?
It's not easy because operating cash flow is whenever there's a business expansion, whenever revenue is growing, right? You need working capital to generate that
Yes.
revenue, right? And working capital eats into your operating cash flow,
Yes.
right? So it's quite impossible where your revenue keep growing
Mm.
and the operating cash flow keep growing, right? It doesn't tally to a certain extent.
Because your payables have to go up as
Yeah.
well, right?
Yeah.
Maybe for software companies, maybe that's only anomaly to them. But if I'm more focused on consumer and manufacturing, right?
Right,
So
right.
to hit that revenue, you need more machineries, you need more workers.
You virtually need capex,
You need
and
CapEx.
and if how do you get a linear growth in OCF when you don't have?
Yeah. And I always argue this point, right? A lot of people got a misconception. Why do you do a business? They say to generate profit.
Mm.
If you really think about it, right, the history of accounting, profit is a product of accounting treatment or accounting theory, accounting concept. I think accounting concept is barely 200 years old.
Mm.
Whereas human civilization, we have conducted business
Yeah,
thousands of years. So I always ask this question: if the purpose of business is to generate profit, so what the guys were doing way back then? You see where I'm coming from?
Yeah,
Right?
yeah.
Because the purpose of doing business is not to generate profit. The purpose of business is to generate cash.
Right.
It's not to generate profit.
And in your experience, you probably analyze thousands of companies, and I'm sure you've come across a few frauds as well, right? We won't name them, obviously, but would you say that the profit numbers and even the revenue numbers are the most manipulated when it comes to fraudulent activities, and therefore we should be looking at the cash flow statement instead?
If I be very honest with you, the reality is this. Sometimes whenever there's a fraud being uncovered, the first reaction from us is, why isn't the auditors aware of it? Know what the auditors are doing, right? But the reality is this. If there's an intention to commit fraud, they were already started to manipulate even at the source document itself.
So the auditors will not be able to.
Auditors are checking on the source document. So that's why I say it's very hard to track when there is an intention to commit fraud.
Right.
The only way we can actually detect fraud is common sense. Whether it makes sense or not.
Right.
That's it. The only way is, and then unfortunately that responsibility falls upon the investor themselves.
Right. So what are the telltale signs? What are the common sense signs, so to speak, that you've had on an accounting basis that a company is, hanky panky?
You see, it depends on the nature of business. Like some nature of business, like for instance, right? Recently I came across unlisted, right? So there was this people looking for me for my views about advice. Hey, there's this company looking for sale. They're in the trading business. Their margin is double digit.
Wow. Okay.
For trading business.
Exactly right. So I said,
okay.
I said, my first reaction, I said, it's impossible. I said, it's impossible, right?
Yeah.
They said, why? I said, look at it. The largest listed trading in Malaysia is DKSH.
Yeah.
Dilton Keller.
Yeah.
Dilton Keller, you look at the numbers, being the largest trading, they're making 2% to 3% profit.
Yeah, and trading is just an arbitrage game.
It's-
Essentially.
yeah,
How can it be
exactly.
10%? You should shrink over
Exactly.
time. Right?
So it's common sense.
Yes.
Right?
Yes.
Yeah.
You can go and check the accounting, you go and check the accounts, you look everything perfectly fine.
Yeah.
Okay.
But the only thing that actually highlights to you something doesn't sound right is common sense.
Ah.
On that similar note, what has been the okay, for the lack of a better word, the sneakiest accounting trick that you've seen so far in your experience? The way that they hide the numbers, the way that they, in a way, fake their numbers is the best that you've seen so far. Any case studies or examples you remember?
The most convenient way for company, I won't say to fake accounting, but to actually continue to generate massive growth by acquisition.
Okay.
Right? Because once you buy, you consolidate their revenue, you go and buy another one, you consolidate revenue. I think that is quite, I would say it's not wrong.
Okay,
it's not wrong,
yeah.
but it's something that is quite smartly done in that sense, right? So
Okay.
that's why some companies, they are going a path of M&A, is actually to generate debt.
Okay.
I've seen that also in Thailand, to be very honest. Very honest. No? I started investing in Thailand way back in 2008.
Okay.
Right? So there are really some companies where I did ask them, can you break down between your organic growth and acquisition growth, right? And they refuse to give you that number. They're like,
Oh,
right.
Okay.
So why is that bad to the investor necessarily?
See, how long can you continue to buy to grow? There is always a limit. And once you reach a certain size, right, you have to buy a bigger company to actually continue to generate that. Right? But then you see, what is the hazard? It's actually more of a moral hazard. See, you're buying a company not because it's going to be good for your investors or this is the right thing to do. You're buying it just to make sure my numbers looks good, that I'm continuing to be looked upon as I'm a very good manager, that I can grow the company in that sense.
Right. So I know you mentioned, I think at our previous company, we have discussions about accounting, and it has to do with the loans, right, for a company when they take loans, right? So there are many ideas or many opinions about loans. Some people call it debt, some people call it leverage. Which word do you like? Are you on the debt, your team debt or team leverage?
I'm not a believer of modern finance theories, to be very honest. Right? You see, all this concept about leverage, right, is designed by modern finance theories. When they start to say you need to improve your return on equities. So how to improve your return on equities? You take more debts. You in a very layman term, when you do a business, you minimize the capital you put yourself.
Yep.
You try to maximize using other people's money to pay, and therefore you increase your return on equities. So all this concept of leveraging for a company in their balance sheet is actually devised by all these finance guys, especially the modern finance theories, right? I am a very conventional mindset guy, right? I always believe in a net cash balance sheet. Right? I'm not a believer of using debts. I think 2020 is actually the best year you actually prove this point. Whichever company that goes down are the leverage guys. Whichever company that are still standing and waiting to take opportunity because the competition has shrunk because a lot of people actually close shop are the guys with very strong balance sheet.
Yep.
Okay. So, I mean, before we move on to the next quarter, right, for accounting, so you mentioned, I think, operating cash flow, and of course, you prefer a net cash position. Is there something else that you look at that you think that, hey, investors should look at as well?
Yeah, it's an important quality.
It's very hard to find out this, but I would say hidden assets. Hidden assets in a sense, right? There are some assets within the company which actually is worth much more in the out of the balance sheet.
It's off balance sheet items,
No,
right?
it is in the balance sheet, but sometimes it is undiscovered.
They never revalue it or something, is that right?
Okay.
I think one of the best example was, of course, Selangor Properties when it was still listed.
Okay,
At that point in time, just one piece of their land, just a single piece of land is worth the whole market cap.
Wow.
Oh, solid.
Okay.
So they probably, I don't know, I never follow, but they probably take the company private at a premium, but not as a bigger premium as it could have been.
If I had to rephrase that, they take it private at a price that is higher than the last traded price.
Yeah,
but at a significant discount to what's actually.
Is it this phrase? What was this phrase that I think investment bankers like to use? It's unfair but reasonable.
Yeah, something like that.
It's unfair but reasonable.
Yeah. Unfair but reasonable. I don't understand what that means.
That's investing.
That's investing.
My favorite quote, you don't have to die, but you can go to heaven.
Okay.
Interesting. I'd like to try that, man. Where can I sign up for that? Okay, so you shared with us some very unique insights about accounting. And then, of course, earlier you shared about the qualitative assessment of the business economics. Now, let's go to the third quarter, which is management. Right? That's one, I would say, of four, probably that is the most challenging one. Because you're trying to figure out, who this other person is, right? And I think, those who are married, who are listening, You may marry someone, you think you know the person.
And then whoops, you wake up.
20 years, yeah. So you sit in the same bed, you are together for so long, and then say it's a different person. And in the case of investing, he's a CEO far away. Probably you never see him in your whole life, right? So how would one? And I think it also ties back to our discussion earlier on about institutions, right, where you guys can actually talk to these people.
Yeah, you have access to these people.
So how would you, or what are some of the criterias or key points or common sense points that you use to assess management quality?
There are a lot of parameters, right? But what my own trigger, let's talk about my own trigger, right? My first trigger is, of course, if the owner keep talking about his share price. To me, that's the first trigger, right? To me, as a CEO, your job is to run the business, right? Your job is to actually deliver the results. Share price is not of your concern. It's not of your control, because share price is being given by the market, right? But most of the time, if the owner keeps saying that my share, especially this phrase, my company is undervalued. So whenever a CEO can tell me my company is undervalued, I was like, okay. That's
why you're not buying back shares?
Second is, of course, if the owner come across too marketing. I mean, to self-promote, to company promote that this is the best company on in the face of Malaysia and things like that. That were actually some of my trigger points in that sense, which makes me a bit uncomfortable.
So those are on the negative aspect of things, right? So what are some of the positives one? Obviously, you can say the opposite of these, but are there some things that when you look at it, wow, that's really good. I want to see that in my manager.
Ultimately, it is really reflected on, to a certain extent, back to how they run the company. Right? Is it very conservative, or do they always use debts or leverage? Are they always on burning cash in terms of that? How they take care of their staff, right? The staff benefit, the staff incentive, how they pay themselves. All this comes into play to how we actually evaluate whether this is a good manager or not a good manager.
How long does it take for you to evaluate? Because obviously, if you meet them only, like, let's say once a year or twice a year, right? Or are there other ways besides physically meeting them to evaluate them, in your opinion?
One thing is, I do when I was managing funds, I do keep in track. I think once a month.
Okay, that's good.
Because if your money is there,
There's other people's money there as well, right?
But do they? Okay, here's a part where I think maybe there's a difference between the institutional or professionals versus the retail guys, right? If the retail guys don't have access to these guys running the business, which like once a month, right? What would be the avenues for them to evaluate management?
That's what I said, the ability to actually, how well you understand the product or the services, are you able to track? I think that's why I said something visible that your eyes can monitor is something very, very useful, right? If you can observe, okay, suddenly that there are more commercials coming out about this product, right? Suddenly there are more people talking about it in social media. There are more people buying it. Suddenly your neighbor will start to use this brand of product. So that means they're doing something right.
I see.
Right. So, Peter Lynch has a very famous saying that find a business that an idiot can run, because eventually one will.
Yeah.
So he seems to be indicating that management, whilst kind of cool to assess, actually is very difficult, and in fact maybe not even the most important thing. So where do you stand on that when you compare business quality and management quality?
I think, see, this actually came from okay, what I'm going to say is actually come from Warren himself.
Okay.
He actually made a very, very good point. He said, if you have a fantastic business, right, or a lousy manager, you still do okay.
Yeah.
But if you have a lousy business and a fantastic management, it's not going to change a thing. Right?
Yeah.
So to a certain extent, the business still take precedence. Of course, look at his best example. When he made that comment was actually Coke. Coke actually had there was a period, I think in the 1990s, right? They have a string of 5 CEOs continuously, which actually destroy the value of Coke.
Yeah.
But because Coke's value is so strong that despite they have a few jokers as running the company, it didn't destroy Coke.
Right.
Had Coke being a much weaker company, you have been destroyed by the first CEO.
Oh, interesting. So before we move on to the final quarter, right? So if you would share with us one experience where you got management wrong. So you assess them and you at first glance analyze, hey, this guy seems pretty good. Then you put in your own money or even other people's money into the fund, and then it turns out, the reverse happened. Do you have such an instance?
No, not really. I think most of the mistake I've done is actually my own judgment problem. Not so much of the quality of management. I think my biggest mistake was actually okay. If I were to categorize my mistakes in investments, right, it all is this 70% fall to the same category.
Okay.
Which I was over bullish on the growth.
Okay.
So you're a growth investor lah.
No, he's pulling a fast one on you.
Yeah, right. Sometimes you try to convince yourself, right? Oh, hey, no, this time it happens a lot to me, right?
This time is different.
Like why am I paying 50 times P for it? Because it's going to grow 50%, 100%, right?
Yeah.
It's going. This is different, that's right. This is different, overpaying for growth was actually my most consistent mistake.
Right. Okay. Which segues very good into the fourth quarter, which is valuation.
Yeah.
So you mentioned you mentioned earlier on about, don't buy stocks at 100 PE, right? But of course that assumes one, that the PE is still a relevant metric. Now, I'm on the fence on this because I hear both sides. One side says that at the end of the day, reality needs to take place. Companies need to be profitable. Then the other side says that yes, it's true, but then the long-term value or the lifetime value of a customer is very long and very high. But for you to acquire those customers, you will need to outlay a lot of capital expenditures, which then leads into things like depreciation and all that things, which will eat into the profits. And so you don't make any profits. Hence, the PE is actually not so relevant in that time period. So in terms of valuation, really what I want to ask is the PE still relevant?
Good question.
Because there's a lot of lost leaders today, those lost leaders, just one market share, grab market share. It says, don't worry, the network effect will come in, and that's where the profit will come in.
They can start monetizing.
Yeah.
Facebook had the same thing. They were loss making with the IPO, I believe. And then after that, they switch on the advertisement tab, and then now they're very profitable.
Even like Grab, today.
Yeah, and you're seeing, Warren Buffett's right-hand man buying Snowflake, which I believe is
loss-making.
Loss-making, Grabs and Ubers out of the world. So where do you stand on this discussion?
Ultimately, I am more on the perspective of whether ultimately is it going to a business that can be profitable. It's really back to the business model. Right? I said it asks a very two basic question. For all these ventures that are still loss making, you ask a very basic question: are they able to actually influence the price, or are they able to influence the cost? These two. But if they're in a business where they can't influence both, then the possibility of them continue to report loss for a long period of time is quite possible. Right? Unless you can be loss making, but then if you have an ability to actually uncover these two, then the whole dynamics changes. Right? A lot of people like to quote Amazon, right? It's doing so badly. People are laughing at it when it's 100 over times PE, pay back then.
Exactly.
But what people don't realize is what is driving Amazon's profit now is totally different from what it was doing back then.
Correct.
Yeah.
Correct.
So honestly, for those who hold Amazon for the last 10 years and they're just lucky, right?
Yeah.
Because it's not something like Amazon created 10 years ago and now it's working. It's suddenly that, I've created web services, right?
AWS.
AWS for Amazon was an experiment. They didn't even know they would succeed.
Exactly.
Yeah.
Exactly.
So
no, it's a good luck. It's really something good. But one point is, a lot of people try to use Amazon as an example, but people don't realize somehow that whatever drives their profitability now is different from the business that was created.
Right.
Yeah, right.
So okay, so you would, from my interpretation of what you said, it seems to me that one, as an investor, should still avoid most unprofitable companies, but you need to understand the business, that if it can maybe turn around, find something new, then it's okay to buy a negative PE stock.
That's an interesting point, because there's multiple answers that can stems coming from that.
Right.
You look at the best investment that I've made are usually on turnarounds. Right? People, those forgotten, or people are so pessimistic. Okay, this stock is going to die. Right?
Yeah.
But turnaround actually is one that makes the easiest return. Right. So that's number one. Right. So I'm not saying that totally avoid turnaround companies, but that is where most of we call it the alpha or the major return comes from.
Yeah.
The second thing is whether it's PE relevant. Right. See, stock market is actually quite complex. See, whether you are successful or not, it actually boils down to more than just PE. Okay, let's go down. If you look at it, I have discussed this in my social media posting, in my book. I asked a very basic question: what drives stock prices? Right. It's actually fundamentally, technically aside, I'm not a chartist.
Yeah.
But fundamentally, you break it down. There's three elements that affect the share price. First, of course, is the earnings growth. Right. Whether can the earnings continue to grow? And to add on to that, the earnings growth must come as a surprise to the market. Mean to say, out of expectation. Maybe market will expect you to deliver 5% growth, but suddenly I can deliver 20% growth.
Okay.
So once there is a positive surprise on the earnings growth, the share price will react, right? The second is re-rating. Meaning to say maybe last time, market only priced them, maybe you're only worth 8 times PE. But then suddenly, because of the first factor, you suddenly deliver very strong growth. Market suddenly say, hey, no, I don't think you're worth 8 times anymore. I'm willing to pay you 16 times. And just simply by the 8 to 16 times, the share price actually doubled.
Yeah.
Right. The third one is actually the most important among these two. There's no official term for it, but I call it follow-through interest.
Okay.
What it actually simply means is that in market, right, whether you like it or not, it doesn't matter. What is more important is whether other people also like it or not. You can love a stock, it can be 4 times PE, you can love it so much, right? But if it's a company that no one else cares about it, it's going to stay at 4 times for a very long time.
Exactly.
Right? So that's the reality. Investing in market is actually much more complicated than just valuation or just a PE. It doesn't really mean that it's low PE, I'm going to make money out of it.
Yeah.
A lot of people talk about glove, right, recently, right? I will give this analogy, very simple, right? If now I have a proposal, I have this stock, I have my company, right? I'm going to sell you for, I got 1 million profit, for instance. I'm going to offer to sell for 4 million. I'm just going to have 4 times PE.
Yeah.
But there is a caveat. I'm just telling you, next year or 2 years down the road, the profit will drop. But I don't know how much it will drop.
Okay.
Maybe it's dropped 500,000, it may drop 100,000, or it may go on to negative. I don't know. But now I'm willing to sell you at 4 million for my business. Now, will you be willing to buy it?
Most people won't, I think.
Exactly, right? See, now I can understand. That's the same situation faced in the glove.
Sentiment, in a way, for lack of a better word, follow through.
But what I'm hearing is that you're saying in year 2, the glove companies will not be as profitable, or there's a chance.
No, because you see, like it or not, right? Demand will normalize. Normalize is not fall. Normalize.
Go back to the old
pre-COVID lah.
Correct. Growth will still be there, but the growth won't be as strong as during this period. Right?
Of course, yeah.
So then boils down. For those who run business, you know, as the $1 million question: can the current average selling price hold for the next 2-3 years?
Right.
Right. It's only a matter of time before ASP will have to readjust itself.
Yeah.
Or the average selling price.
Reversion to the mean.
it may not. Okay, if I give a very simple example, assuming our average say $20 previously before COVID.
Yeah.
Now say for instance theoretically it go up to $100
per 1,000 pieces.
Right.
Yeah.
So even after adjustment, it may not go back to 20. It may go back to 50. See, 50 is still much higher than 20.
Yep.
But from 100 to 50, that's 50% off.
Yeah.
See, so that's why now we can understand why, despite a lot of people saying that it's cheap, it's single digit, but why it's not getting that follow through interest? Because people are just waiting to see how much it's going to drop in future.
I see.
Because readjustment is a certainty.
Yeah.
The only uncertainty is how much.
I see. So in a way, if let's just say to follow through that question, if the readjustment exceeded people's expectation, that means let's just say they foresee ASP to drop by 50%, but after 2 years normalization, they drop by 30%. Just to give an example, then the analyst will come out with a re-rating, then there's more people, market, that is the follow-through that you're talking about.
Until more clarity can be seen about
I see.
what extent is the impact.
I see.
So then I guess the next, question that we all want to know is, in your view, right, how do you gauge follow-through interest? How do you tell?
Yeah. How is it measured in a way?
Yeah, what's the closest thing you can have to measure? Because I know this is it's like trying to figure out the mood of the market. Right?
yeah, correct. Actually, the sentiment of the market.
Sentiment, right?
There are periods where it's quite easy to guess.
Okay.
Quite easy to predict, quote unquote.
Yeah.
There are some periods where it's quite difficult. Like last year it was very easy. I'm still remember way back in March, right? Before the big so I said we just think of perspectively. Everybody had to go. There's a lockdown. People had to work for home.
Yeah.
Definitely the demand for devices will increase.
Yeah.
The demand for bandwidth, right?
Yes.
And so on and so forth. And therefore, the tech is always the best beneficiary. So it's quite obvious. But of course, I think I mentioned in March, April, and May, people was like, are you sure? Right? But when subsequent anything catches up, then you have that the super tech run on that basis, right?
Yeah.
Now think about it. Now we are talking about vaccination. I think globally, as we're talking, I think there's already 400 million of vaccine being administered on humans, right?
Yeah.
Okay, so now we're actually talking about recovery. So now think about it. Just put yourself as an investor, right? Now during a recovery stage, what do you think will benefit?
So Peter, what is benefiting?
I wrote a poem early this year. I'm not sure.
I read the poem. Yes, I read the poem.
Long and short, one of it is like think about it again. Very logical terms. Right?
Yeah.
There's a lot of businesses last year. They are good companies, but they are not able to generate that sales because of lockdown.
Yes.
Right.
But once the market start to or the economy start to open up, these are the survivors' strong balance sheet. So these are people who are going to capture the market.
Correct.
So their lack of sales last year was not due to a bad management, bad.
Yeah.
It's just the industry
Just
dynamic.
circumstances.
Circumstances just
Right.
went down.
Mm.
So think about it. Once the economy start to open up, what will their sales be? And then compare to that to what is the current valuation.
Yeah.
So these are the easier part to actually see forward of what is the next industry that's
Right.
going to
So you mentioned C4, and that's a very interesting thing, right? Because one response to your point about Top Glove could be that
Even though I'm not saying about Top Glove, glove generally.
yeah, glove generally. But of course, I think the people are talking about the big three, like Hartlega, Top Glove, and Sumax. Now we're not talking about individual stocks. You're right, but I think one response is that yeah. So we get that follow through interest is important, but it's hard to know when it's gonna come.
Yeah.
And so maybe I'll just put a position earlier. I rather be earlier than late. Does that make sense to you?
See, investment is all about being earlier than other people. You have to see the trend much earlier.
Yeah.
That's how it works, right? If you really think about it, right, do anybody still talk about daily cases?
No.
Do anybody still talk about COVID?
I'm immune to it already.
Yeah.
Actually.
So see that COVID trend has already ended. See, just that we don't take a step back to think about it. But if we really take a step back to think about it, we have stopped looking at what's the daily cases. We have stopped looking about COVID.
Yeah.
Traffic jams are back.
Yeah.
So now actually,
Sadly, yeah.
just think back.
It's
We're
back to
talking about
normal.
It's back to normal. So what are that businesses that are going to benefit once this back to normal trend goes on?
So I'm gonna name a few industries, and you tell me what you think. Okay. So I think one industry that didn't do very well is the retail industry. And let's start with the retail industry. What do you see in the retail industry?
Retail definitely will be coming back. But again, it depends which companies, right? There are some companies where the retail are not so Malaysia-centric. They are more globally centric, and that one is actually more challenging. But in terms of Malaysia-centric,
Okay, why is it more challenging if it's global?
it's a different dynamics.
Okay.
I mean, when I talk specifically about listed companies in Malaysia, right? There are certain...
Yeah. I know.
I shan't name names, but I think that is more challenging because of the location that they're operating their business.
I see.
There are some that I think still quite well. There's one that has tons of cash in the balance sheet. It's quite interesting.
You guys got the hint already, huh? Go start hunting, guys.
So in the US, you're already seeing this trend, right? You look at US statistics. There's this thing called revenge spending that already happening.
Oh yeah.
Wow, interesting.
Don't even talk about looking at data, right? I think even if you ask around your peers or your family members, right, they are more willing to spend because of this pent up demand. They have saved so much, income still coming in, and then all of a sudden, they spend double of what they used to spend on this particular item because of that.
Yeah, and speaking of the US, they have that 1,400 stimulus check, right? So it's like the revenge,
Spending.
right? So that's retail, lah. Okay. How about so you mentioned traffic jam just now, automotive.
Automotive is tricky because there's a global chip shortages
Ah,
at this moment,
okay,
which cause a lot of cars. The demand is there, but a lot of cars can't be produced. I think that's the challenge.
I see.
For automotive.
I see.
I'm quite worried about that. In fact, I have my market outlook session in January. I
Yes.
mentioned it. The automotive actually is a very important part of the global economy because of the whole value chain is very, very wide.
Of course.
But if
That's why Tun M wants to build
national
a
car.
national car here, right? So we can have a lot of jobs. But okay, different discussion.
No, because remember Peter used to share, there was one session that he is actually, I don't know whether your stance has changed, but you are supportive of the national car project, right?
We have to separate both aspects, right?
Yes.
We have to separate between Proton as a company in terms of the profitability, but on the separate is a national car plan.
Yeah, the policy of having a national
car plan. You see, if you really think about it, right, whatever we see about plastic injections, metal stamping, all this will have not been made possible had we don't have automotive.
Agree?
It actually is still possible, but the automotive sector actually accelerates this metal stamping, this resins, these plastic components, which comes to what we are seeing in our EIE today.
Yeah.
Right?
Yes.
Actually, it spurs from that.
I see.
So, in terms of decision, I was saying that it was right, but in terms of a car, that was wrong.
The company and the car was wrong. Okay, yeah. Okay, great.
So, I mean, the automotive industry is very big, as you mentioned, right? So, there are many places in the supply chain. Having analyzed the Malaysian market, automotive-wise, for quite a bit now, right? Would you say that there are actually many companies, of course, you're not going to name names, but would you say there are many companies actually linked that are listed that, Malaysian investors can actually look at as an attractive investment?
I think the unfortunate part is we don't really have an automotive company in Malaysia. really don't. In the sense, if you think about it, how do I define automotive companies? Are companies that really creates their own.
Right.
Like the GMs or the Fords of this world.
Yeah. You see, even as much as we like Perodua. I mean, I like Perodua. It's a very decent car. But no, Perodua, we all know, they are rebadged Daihatsus.
Yes.
Rebadged Toyotas, right?
Yes.
You just come a blueprint, you just change the grill a bit, just change the specs a bit.
Just
And
slap,
the
and then
name,
slap
yeah.
a badge on.
Badge. There you have.
Yeah.
It's a Perodua.
Yeah.
I think Proton was really the closest company that comes to creating their own car.
Mm.
Which is true. Started by the Proton Waja in the year 2000.
Yeah.
It's really created by Proton.
Especially the Campro series, right? That time.
Yes. So, but unfortunately, once it's privatized, and now you see, it's unfortunate, it's going back to the old direction where now again Proton no longer manufactures its own car. I mean, the X70 is a rebadged Geely, your X50 is a rebadged Geely,
Correct.
and that will be the direction going forward. So if we really ask the basic question, do we really have an automotive company? We don't. The other categories are all distributors, right? Burmas is distributor for Mazda.
Yeah.
Tanchong.
They're just distributors. They don't really manufacture car per se, right? So I think that's quite an unfortunate part.
So how about the supply chain? So maybe the components within the car. So like you mentioned earlier on that there's a chip shortages. So that may not be able to fulfill demand because of supply issues, right? So what does this mean for the guys producing, I don't know, certain components of the car, maybe the glass, the chassis?
So if you think about it, right? Now the hot thing about semicon is, of course, the shortage. So people assume your prices are going up. But if a car cannot be produced, the car wouldn't be putting your component in. You may be able to see the fruit, but not able to enjoy it. So you may have this theoretical prices for chips are soaring. Yes. But if the car's not producing, what can you do?
You have the water but no fertilizer. So
Exactly, right?
yeah.
So I mean, things are more complex, than just. But you just see a very simple perspective. Oh yeah, no, there's a chip shortages. Chip shortages prices are going up. Let's invest in the tech stocks.
Right. But I mean, like just going back to automotive. Of course, there's no, like you said, creator of automotive industries. But is there any opportunities for any investor to hop onto this automotive train? As in, if it grows, like you said, there's demand, and I would assume, and correct me if I'm wrong, that the supply demand gap will shrink a bit. So this is an opportunity in the automotive industry. Anyone in the Malaysian space that if an investor wants to take advantage of, they can.
Numbers are very important. When I said numbers is you must understand the number of cars being sold, right? I think I shared with you just now. Previously, Vios is around 4,000 a month. That's the highest. Previously was the highest. Now, actually, City has overtaken the position. City is around 3,000 to 4,000 a month.
Okay.
On a per model basis, right? The highest number is always Perodua. Myvi has the sole spot of 7,000 a month. That is unbeatable for many years.
The king of the road.
The king of the road. Now I understand why you turn left and turn right, it's always the Myvi, right? Because it's 7,000 a month. And really, no cars that actually hit that magic number. I said the next highest is 3,000 to 4,000. You have this 7,000 in Myvi.
It's double,
It's double.
Yeah.
Then I understand why there's so many Myvis on the road.
Yes.
Next, I think it's Beza. I think Beza plus minus, I think it's almost 4,000. If I could be wrong,
Okay.
because they stopped publishing the official statistics.
Interesting.
Many years ago. Okay, so why I said numbers are important, right? See, when Burmas was or Bijaya Auto was listed way back in 2014, 2013, I say 2013, right? It's a very easy decision because of the numbers. See, that time Burmas was only selling maybe plus minus on a month basis purely 900
cars.
So
combine all the models.
all the models. So that time when they go for this, they say my target is to hit 1,008 double.
Okay.
So when you look at double, can or not? But if you look at the numbers, right? All the models combined is 900.
Yeah.
Can Mazda sell combined 1,008? Why not?
Yeah.
So it's actually very achievable. So that actually gave me the confidence to actually go for subscribe for the IPO. I mean, under the funds that time, right?
Yeah.
And true enough, I think within 2-3 years they actually hit that number. So I say for you to invest in auto car companies, that's why I think that understanding that numbers make sense.
I think MJ is coming from a point rather than just purely look at an automotive even a manufacturer or distributor, right? He's saying that let's just say there are certain companies that produce components of a car manufacturer, but may not necessarily be a car manufacturer in Malaysia. So those companies that are in a value chain in Malaysia that supply to probably a global market, to a company.
It's very difficult. It's very difficult. If you think about it, Malaysia it's due to the policies, right? We are not really a global hub. A global hub is more of Thailand. Then it's really more of a global hub, more regional hub to be in lack of a better word, right? do notice in Bursa Malaysia for the last 15 years, do notice one by one of the auto parts company have actually started to delist.
Oh,
Now,
no.
Oh, I didn't notice that. Okay.
a lot actually been delisted,
Okay.
voluntarily delisted, right? They actually exit the market.
I see.
So now, if I reverse the question, what are the auto parts company you know that is still listed in Malaysia?
There's not much actually. Actually, more for some may be doing testing services for the auto industry. Some may be supplying maybe OEM parts for certain parts like the LED lights and all that kind of
They
thing.
still rely a lot on Prodo and Proton. So
I
not so much of
see. I see.
on the global. We are actually out of the global chain. To
I
a certain
see.
aspect of it.
Mm.
So again, it's quite unfortunate.
It's quite sad.
Yeah, no, because
it's sad.
I relate to what you said because I have a friend. He's one of the largest spare part suppliers in Malaysia. He supplies parts to Produa, Mazda, and all that. He doesn't get his parts from Malaysia, all from Thailand.
Yeah.
Everything from Thailand. So quite sad.
Well, stop talking about sad things now. Okay, so hopefully, so now we go to oil.
Okay.
And when I say oil, crude
Okay.
and palm. I think these are big contributors to the Malaysian economy. So oil has not been doing too well, but it's slowly creeping up. I've not really looked at the palm oil industry, but it's linked to if people go for more shopping, if people go out to makan, buy things or that, I would assume, I don't know, but I would assume that palm oil would have some sort of resuscitation. So, start with crude. Where do you see these two oils going?
What is interesting is, my monthly market outlook session, in fact, one will be end of this month. Actually, we're talking about this. Almost we're complaining about this so-called, I call it the super
commodity
cycle.
Right?
Yeah.
Not I call it, but is it real? If we really take a step back and think about it, right? This is not a new theory. This super commodity cycle theory has been around since the year 2000s, right? Where everything spike up.
Yeah.
But if you take a step back, I say investing about common sense. Take a step back and think about it. If this cycle really makes sense, but why isn't all commodity prices continue to go up from then until now? Why it's not like
it should be a linear trend going up.
it should be, right? Because you see, the basis argument behind this super cycle theory for all commodities is it hinges on two aspects: the increasing human population and the scarcity of land bank. That's it. It only hinges on these two, and it's still apparent now as compared to then. So if this super commodity cycle is true, right? Then why isn't the prices moving in that direction? Right? Because whatever is true, then it's still true now. I mean, human population is growing. It's quite scary. We hit 1 billion population, or we add 1 billion population every 10 years.
Wow.
Solid, yeah.
It's
Crazy,
scary.
man.
Every 10 years, we add 1 billion population.
Biggest contributor? China, I guess, or India.
China will be shrinking soon.
China
Already.
is
I think it's in
shrinking. Yeah.
India, Indonesia, Brazil.
So C and the BRIC countries, I guess.
No, Russia is not. China is not.
Yeah.
India is. Brazil, yes.
So if you cut the last 3 spike of commodity prices, see, in the year 2000 to 2008, that spike was actually due to, as I remember correctly, the BRIC. It was at that time China was actually fast implementing infrastructure projects, right? So they actually consume major importer of all the commodities.
Sure.
Yeah.
So that caused the first surge in commodities.
The steels, the
Yes,
copper,
correct.
yeah.
So it ended because of the great financial crisis, right? The second surge was actually in 2010 to 2012-13. That one, I call it, was mainly driven not because of BRIC expanding economies. It's really more of there's too much excess liquidity because of
Stimulus and all that.
stimulus.
Yes.
Now we're actually at the third stage of a major rise. So if you really take a step back, what has really changed? To me, I was still this is my personal view, right? That the current surge is not so much of demand and supply, but again, it's back to liquidity issues. There's just so much stimulus globally, and all these financial instruments, the liquidity actually goes to all these futures, your CPO futures, your these futures and whatnot. So what my take is, commodity now is actually no longer being affected by supply and demand. If you really go and plot the chart, be it any commodity, soybean oil supply and demand, CPO supply and demand, oil supply and demand, there's no shortages in any commodities.
It's really stimulus money, helicopter money lah.
It's like of the money.
Alright. So I mean, fair to say, based on what you're saying, is that essentially the prices are a bit artificially stimulated in a way.
It's the futures, yes. There's so much excess liquidity in the market. Then you look at Malaysian planters, right? That the other aspect of it, another $1 million question, right?
Yeah.
With CPO hitting this 4,000
4,000,
but
yeah.
why isn't the share price moving?
Yeah.
Because there's another aspect of it. First thing is, I said, if you really look at it, what is causing this surge in price? The first question that you ask is this sustainable? My take is, I don't think so. I don't think it's going to be normal. I would say normal. I don't think it will stay at this level for a long period of time.
Okay.
Because if you look at it, it's also affected by soybean.
Yeah.
Soybean is going to be quite a massive planting this year. That's going to avoid that. So if you really look at the price of soybean and the price of CPO, somehow magically they're quite close to
Correlated.
95% correlated.
They are substitutions, right,
Yeah.
essentially, right?
But that's the funny part. They are not really substitution.
Ah.
Because, see, interesting part, see, soybean oil or soybean oil is actually not a main product.
It's a byproduct.
It's a byproduct. The main usage of soybean is actually animal feed.
Yes,
Yeah.
yes, yes.
So when they
Agriculture
it's
feed.
agricultural feed. So soybean oil, it is a byproduct.
Yeah.
And if you're a mill that uses, or if you're a mill that mills CPO, you cannot interchange now today. I got mill CPO, now got mill soybean. But somehow, right, people view it as a competing product, which is quite amazing.
Yeah.
I can't explain why,
Yeah.
but it is being deemed as a competing product, right?
Mm.
So that's one aspect of it. The second aspect of it, you look at profitability of Malaysian planters.
Mm.
It actually declined substantially.
Oh.
Why is that? Why is that?
You look at maybe plus minus 15 years, 20 years ago, maybe they can have a GP of 40%.
Okay.
But if you
Okay.
look at their GP now, it's barely 20%. Cost structure has changed.
Is it because of minimum wage? Because a lot of I know palm oil planters, they rely a lot of foreign labor because it's very labor intensive,
And
right?
also government policies. Government policies also is not doing the cost, not creating a favorable cost structure
Right.
in
I see.
Malaysia.
I see.
So definitely the profitability of planters now are not like way back in the 2000s, right? When
I
that time when there's a
see.
commodity boom, everybody benefit.
I
But
see.
now because the cost structure actually changed,
I see.
so they may not be as profitable as they used to. be.
Right.
I
So
see.
that actually gives a perspective of why is it, despite CPO hitting this level,
Mm.
why isn't the CPO price or the planters rally the share price?
Mm.
Right.
Good
so,
insight.
so does this mean, right, that people should be in a way staying away from the palm oil industry, or does it mean that actually because the reputation now is so bad, there's not a lot of follow through interest, so to speak, therefore there's some opportunities for undervaluation? Where do you sit when it comes to palm oil?
Honestly, I don't really follow palm, so I'm not expert
I
in
see.
this
Okay.
area. So
Okay.
maybe, but for investors who, if you are in the palm oil business
Mm.
and you really know that this price is going to sustain,
Mm.
and you can really, honestly, you can really predict, right? You can really see that this trend will sustain. Then you have that industry knowledge.
Mm.
Then be comfortable. Then you can actually invest in it.
Mm.
But because I'm coming from an outsider view, which I view it, I could be wrong, that it's not going to be sustainable.
I see.
Therefore, I'm not investing in it.
Mm.
Right.
Understand.
Okay.
Yeah.
Great. So you talk about just last two industries which are linked. So one of the big things that unfortunately now not a lot of people are talking about, but one of the big things that happened during MCO was moratorium, right? Banking. Right, people are saying, "Oh, now no one pays the bank, so the banks are going to be really bad." I think
Yeah.
Maybank, Public Bank, all that took a huge dip in price.
Correct.
Huge by banking standards, lah. Okay?
Yeah.
Not tax standards. They're different. Huge. I think it's like down like 15, 20, or maybe even more percent, right? So, if I were someone, going back to your original point about looking forward, right? That now MCO is over, no one really cares really. Hotpot places are super packed and all that. And now moratorium is lifted already, right? I'm saying, yeah, it's lifted already. And then now, would that mean that there's going to be a banking recovery? One. And two, one industry that is very linked to banking is the building or the construction industry, right? Because they presumably they get a lot of loans from there, right? You need a house and all that. So what do you think of these two industries?
Okay, if you look at banking, you must look at the way they account for their accounts, right? So even during the loan moratorium, the interest accrued are still being accrued.
Yeah.
So they're still recognizing that.
It's just deferred in a way, right?
No, they just recognize that, but at the same time, they actually will recognize a potential impairment on it.
Do they call it reserves? Do they use the word?
I don't know what term they call it. I mean,
Okay, yeah.
Okay.
But it doesn't show out on the cash flow because no one's giving them cash. But
correct.
But on the gap earnings, they
Yes,
have.
on the earnings, they still recognize that it's not a non-performing loan.
It's not an NPL.
It's
yet.
not NPL yet.
Yet.
Right? Because as long as I'm just accruing, there's a moratorium of 6 months, but during the 6 months, actually, they are still accruing, recognizing the amount that you should have been paid.
Yeah.
Right? And at the same time, they are doing provisions to it. On
The provision,
possibility-
yes.
On the possibility that you can't pay.
The impact
Do they
provision.
call it GIL? Gross impaired loans. Is that the term they use? I remember I was studying this. I don't know. Okay, anyway. Yeah, sorry, continue.
So direct, actually, there's not much impact, quote unquote. The only impact is coming on the provisions. That is actually. Yeah. So as long as people are still paying, or they may be paying a lesser amount due to the restructuring of loan, so it's not being recognized as a non-performing loan. But one thing for sure is look at last year, which is quite interesting is, do you know actually banks did very well. Generally, all banks did very well on the treasury side.
Mm.
So actually, treasury was performing at record level
Wow.
last year. But again, why you're not seeing it in bank financial statements is because of the provisions.
Mm.
My theory is it will look very evil if the bank during this period report abnormal, supernormal profits, right? So you have to match expectations. So you better put in more provisions to make it look
Park provisions, and then the moment everything is back to normal, then release the provisions.
because you know what happened, right? Assuming one bank go and report super more profit, then the people will go and make all the rich. Hey, why there's no profit?
Why the rich get richer? You know?
Yeah, you should have moratorium. No? Record your profit, right?
You should suffer with all of us, you know.
That's my take, right?
Yeah.
Construction activities, look at it on just on the perspective. Maybe say assuming before COVID we mark it at 100 level, right?
Yeah.
Because during COVID that time it's down to 20.
Mm.
Now you're actually coming recovery to maybe 30 to 40.
Okay.
So it's actually not reach a just take 100 as a benchmark.
Yeah,
right?
yeah.
So now actually recovering from 20 to 30 is actually very, very good activities.
I see.
You take some time before it goes back to the pre-COVID level.
I see.
But definitely you're seeing more construction activities coming along now.
Mm.
And which again, you're right. Just when there's more construction activities, there's more working capital.
Mm.
And this will actually benefit the banks or the
Yeah.
finance industry.
Yes.
So I mean, I have two questions about construction. The first is, why do you think that it is not back at 100, right? Why? And the second one is, if you were to invest in the construction industry, because it's a huge industry, right?
Yeah.
What are some of the pockets you would invest in, or you invest in all pockets?
I've never really invested in construction companies
Mm.
because see, what's interesting is, it's always a joke, but it's real.
Right.
In Malaysia, nobody invests in construction companies for the profit.
Oh.
You invest on the news flow.
Oh.
You notice or not?
Whether they get the project or
No,
not.
as long as even before I get the project, share price will go. Once they announce they got the project, the share price will drop. And nobody will go and wait for them to deliver the earnings from the project.
It's just the whispers in the market. Buy at the whispers, and then the moment the thing is,
And now
just,
it weaken. Simple. See, have anyone actually waited to count how much
True.
Gamuda is making for MRT2?
Or even
Nobody
GCAN,
cares, right?
or even GCAN, right?
Nobody cares. As long as it's going to get the rumor. I think it's going to get the MRT2. Or the share price will go up already.
Yeah.
Once announced, they want the MRT2, the share price will weaken. And that's it. That's the end of the story. Right? You have to wait for the next major announcement. So nobody's going to wait. Wait for MRT delivery? How much? Go and ask any analyst. How much is MRT contributing to Gamuda's profit? Nobody knows.
Yeah. That's
Nobody
a good
cares.
point.
Right?
Gosh, man.
Yeah, that is a very
Insightful.
That's one aspect of what you discuss, which is the follow through interest. It's this kind of interest, right?
Exactly.
Right. Whereas like you look at the top glove or the Supermax one, everyone's starting to calculate ASPs and the Ps. Everyone knows the earnings, how much cash they have.
Or they're taking guesses at how much they're going to earn per quarter, right? It's like, 2 billion.
I find it very
No,
interesting.
that's the first element. That's I stress. See, earnings growth is one thing, but as I mentioned, the earnings growth must come at a surprise. If your earnings growth is already within market expectation, there's no surprise.
It's already parked in.
It's parked in.
Yeah, understand.
Wow.
Yeah.
Okay. So that's okay. So I think we breezed through, I think, 8 industries that have potentials for recovery. So this is for those of you listening, this is your 6 months, 12
I
months.
think
Look ahead.
we forgot one industry, building mats.
Building materials.
Which is linked to
Yeah.
So what? Tell us about it.
I think among all the building mats, I think steel price has already recovered to a certain extent. But I think there are other building mats which again going to benefit when these construction activities actually start to gain momentum. I think it's also one industry that I quite like it to a certain extent.
I see. So what is the difference between analyzing and buying companies that build and companies that supply building materials? What is the key difference between these two?
The key difference is for all these construction companies, I said their share price moved due to news flow, not on deliveries. But whereas the activity base will affect the building materials guys. So see, the building materials are more affected not by the news flow of they winning certain project, but the building materials will be more affected by when they really start to implement the project.
So it's a bit more rational.
It's a bit more rational.
Right. So when you say building materials, because I've never analyzed the industry before, I'm thinking of things like aluminium, things like iron, what else? Rubber, cement. Are you referring to this kind of companies?
Yep.
I see. Okay. So guys, start hunting, right? So
It comes from MJ, it didn't come from me.
Yeah. So okay. So I think we talked a lot about. Do you have anything else to say about building materials? Just
No.
Okay, good. Now we talked a lot about what recovery stocks or industries that might be, i.e., undervalued opportunities. Now let's go over to what you think are, in your view, more overvalued. So, or rather unattractive. I wouldn't use the word overvalued, like unattractive. So you mentioned earlier on that gloves, in your view, is a bit unattractive because of follow-through interest, right? So one area that has a lot of follow-through interest right now, maybe slightly less so now in 2021, is the tech sector. But I don't think the prices have crashed a lot. They have corrected only. So I think there's an interesting situation now where, at least quantitatively, on a P basis or whatever you want to use, the tech sector looks overvalued, just optically. But yet there's still a lot of follow interest. So going back to your point about the 3 points, right? Earnings growth, valuations, re-rating, and follow-through interest. How do you analyze and think about the tech industry right now?
If you look at the tech industry in terms of the tech index PE, that's on average, right? We are actually now at close to 52 times.
Wow.
And the last time we hit that number was way back in 2001, right?
The tech.
It was the tech boom, right? To that extent. Okay, I always explain to people that, see, for the tech industry in 2021, earnings is not the issue, or earnings delivery is not the issue. Definitely, generally, I wouldn't say all, right? The tech's earnings for 2021 is definitely going to be much better than 2022.
Yeah.
The challenge for investors is not so much of whether they can deliver the earnings. The challenge for investor is whether the earnings delivered meets the expectation. Now, a very simple example, right? Assuming that you invest in a tech stock and you're going to pay 100 times P for it because you expect the profit is going to double. So you say, well, if the profit double, I'm only paying 50 times for it. Okay, now what if by the end of the year, the company delivers 80% growth in profit, which is no short of fantastic, right? It's still very, very strong earnings growth.
Yes.
But then, if you think about it, will investors be celebrating or will investors be disappointed?
They will be, because their target was more than that.
Exactly. So I said the challenge for tech stocks in Malaysia this year is actually not earnings delivery.
Right.
It's whether the earnings delivered meets the
Expectation.
extreme expectation of investors.
Yeah. Because it's a lot of times people say this time is different. Oh, the boom from COVID is going to propel semicon to a new level. That's why the justifications is justified in a way. But
I think one thing. Okay, so let me pretend to take the this time is different side, right? So let me tell you why this time is a bit different from 2001, which you mentioned. Okay, so in 2001, the cost of capital or interest rates were a lot higher, right? So obviously, if you 50 times earnings, that's a 2% earnings yield, whatever it is, and maybe let's say we gross 100%, then that's a 4% earnings yield, forward earnings yield, right? Today, when you take a 4% earnings yield and you compare it to whatever we have today in terms of fixed deposits, it's
risk-free
like
rate,
sub 2%.
yeah.
But I think in the early 2000s, it was a lot higher, maybe at 4 to 5%. So back then, you could say logically, if the tech index is at 50 times earnings, that therefore, and you can put it in risk-free for 5%, it's a clear case of undervaluation. Today, there's a lot of liquidity. So that if there's a lot of liquidity, interest rates are low, people want to park their money into elsewhere, right? So that's one. Number two is because of this, the follow-through interest, despite the correction for the tech industry, is still decently high because tech is apparently going to solve all the problems in the world, right? So, so because of that, people might still think that there's room to run because of this, and that's why this time is different.
Yeah.
So tell me why it's not different this time.
Just playing devil advocate.
Yeah. I said expectations.
Yeah.
They're going to deliver. This is going to be different. And say, okay, I said they are going to deliver the earnings.
Yeah.
But what if the earnings they deliver is below what you expect?
Right.
So the culprit is investors' expectation.
Expectations.
Not the delivery.
Right.
Investors' expectation.
So if let's say it reverses, let's say instead of hitting 80%, it hits 120%, will you reconsider your thesis?
No.
Okay. Thank you for your honesty.
Because bear in mind, right? Semicon is still a cyclical sector.
Oh, yeah.
The only difference is it a longer cycle or a shorter cycle?
I see. Yeah.
But being a longer cycle doesn't eliminate the fact it is a cyclical sector.
Yeah.
Yes. Yes.
I want to tie this into something that happened to you in 2018 when I still didn't know you, but then I was reading about you, right? I think on Edge you were called like a fund manager of the year or something like that.
Semiconductor king.
Semiconductor king. So the king now is not so fond of his kingdom.
He changed kingdom,
Yeah,
right?
he changed kingdom. Now he's a buildings material. No, I mean, Joe, sorry. So I remember you. I think it was something like 51% return. And then what was interesting about the second edition of your book was that you said 2019 was a challenging year. I presume because of your exposure to tech, because it was also during that time where tech was having not a very fun time, right?
Yeah.
2020, 2021 so far has been a fun time for tech, but 2019 wasn't, right?
Yeah.
So is that why you're calling it cyclical, or were there other lessons that you learned
That's
from
actually a
that?
very good lesson. It's
Yeah.
when Trump called for the trade war in early 2018, there's a lot of negative sentiment towards tech. So actually tech went on a downtrend from 2018 to 2019.
Okay.
Right.
But in reality, you look at earnings deliveries, actually in Malaysia, 2018 and 19, tech was the sector that actually delivers earnings growth.
I see.
Right.
So this comes to the third, what's it called, follow through interest rate. You can deliver earnings growth, but if the market is just not interested in you, they're
I
not interested
see.
in
So
you.
that was a learning from you, like in a way, lah.
It is. It really comes, that's it. Investment is actually much more than just valuation, than more than
Correct.
just earnings growth deliveries. Right?
The market doesn't care whether you own the stock or whether you think the stock is undervalued. It's really about what they think about it, lah.
So that's why remember I mentioned the follow through interest is the most important factor.
Okay.
Yeah.
Okay.
All right, man.
Yeah.
No. So anyway, because you're in the washroom just now, we're just talking about industries that he thinks are not so attractive
Great.
and undervalued.
Yeah.
So talk about glove tech. Are there any other industries you're looking today, whether local or global, where you think like it's a bit frothy?
I really wish you don't keep repeating me on the glove. I saw what happened to the Edge when they write about glove. I saw what happened to Macquarie when they write about
Oh yeah, man. The Macquarie. No, you should see the Macquarie one, man. I think the trolls descended.
So please don't stop quoting me so much.
No. You see, that's why what you said was very good. I don't think anyone will kutu you. You know why? Because you said it's about follow through interest. It's not because people are saying it's undervalued. You're not saying it's not undervalued. You're saying that the interest not so high only. So either you go somewhere else like building materials, or you wait. That's it.
Yeah.
Right.
If there's any troll, please come to FIRL.
So yeah, but so anyway, anyway, I mean, apart from those two, are there any areas that you think that it's a bit frothy? You know,
Not really. Look at let's take Malaysia for instance. This is actually the two best performing sector,
over the past
or
year
to
or so.
rephrase it, right? The only sector that actually performed in last year, right? All the other sectors are actually quite performing. Didn't really perform that well. Still performing quite badly, right? So I think markets move on. Let's say follow through interest. It's always the trend.
Yeah.
Right.
Every dog has its days.
I like that phrase.
What are the possibilities of those companies who are not in favor last year become the star this year?
Those fallen out of fashion.
And you know, tying back to your point about some of your accounting metrics or quantitative that you look at, because the thing about recovery stocks also is that they might fail, right? And would it be fair for me to say that it makes even more sense now that if you're going to go into recovery stocks, that you buy companies that do not have a lot of leverage, because they will have the best chance of surviving this tough period.
Correct. That go for the market leaders, those with very strong balance sheet, right? Because last year that's capitalism.
Yes,
or that's free market, right?
Right.
And any recessions or any economic challenges will actually cause those weaker to close down.
Yeah.
Whoever stronger will be left to capture the balanced market share.
Survival of the fittest.
Right. Okay, man. Now, before we talked about some of your other projects that you're working on now, like Trident and all that, I just want to ask you, right, of this 18 years of investing now, what are the biggest investing lessons that you've learned personally? And having seen so many different characters, so many different type of investors and whatnot, what is the biggest mistakes that they make?
I said the bulk of my mistake is being too optimistic about growth.
Right.
Okay. Exactly, this is the situation, right? I mean, people wouldn't mind paying excessive valuation simply because, well, this time it's going to be different. The earning growth will be this much, right? So overpaying for growth, I think it's going to be constantly. I mean, even I'm still learning how to manage this, right? Not to be too optimistic on things that I like to a certain extent. Right? I think this is one big challenge that investors need to manage.
I see.
Right.
And from the sentiment that you see in the current market, right? Are people, I mean, over time from the beginning of when you started investing until today, right? You still see that sentiment. People are still overpaying for growth.
They are. I mean, okay. For those who are aware or do more research on the numbers, right? Somehow some of them are still more aware to pay for growth, right?
Okay.
Overgrowth expectation to a certain extent.
Okay.
Of course, there are other categories who don't know any numbers, but as long as the share price grow,
Yeah.
That's valuation. Share price grow.
Momentum. It's called momentum.
Yeah. Okay.
All right. So so now I know we were supposed to go into Trident and a little bit about your charity, but I forgot to ask you one very important question, which is actually about careers.
Oh,
in
yeah,
the
yes.
fund management industry.
Correct.
So I spoken to you before. You are actually, I would say, you are pretty 50-50 on whether someone should become a fund manager or an analyst,
Yeah,
right? Correct me
yeah.
if I'm wrong,
Yeah,
right?
yeah, yeah,
But I want to ask you two questions. One, what does it take to become an analyst or a fund manager? And two, because now this is specific to be in the industry. You can be an investor without being an analyst, right? But suppose someone wants to become an analyst or a fund manager, what do they need to do to not only get in, but also excel? So first question. Second one is it a good idea to become one in the first place?
I think the unfortunate part is the analyst and fund management industry is a very small industry. Very, very small. I think give and take, right? I don't have the official statistic. I think the whole Malaysia, there's less than 500 maybe.
Wow.
Including fund managers, analysts, everything.
So it's a very niche market. You can count yourself, right? Say asset management houses, right? The most, how many fund managers you have? Even the big ones, maybe you have 5 fund managers, right? That's it. Analysts, maybe you have another 5, 10. So 10 per houses. So you just multiply yourself, right? So it's very small
So there are more stocks than analysts.
Definitely for sure. I think so. Maybe if I bump to maybe 1,000, but still,
Still very low.
It's very small. So it's really not easy to become an analyst. So this is just by observation.
Yeah.
So a lot of people are able to get to be an analyst at a very junior level. It's mainly of connection.
You know people lah.
You're somebody. Because you see, what contributes to that factor is when asset management or even when people are looking to hire analysts, people don't like to train from scratch. They'll rather pitch from another experienced person and you just join, so I don't have to train from scratch. So that further exaggerate the whole situation.
I see.
That's why you notice that it's really very seldom you see any adverts on analysts for hiring analysts.
I didn't know this.
I just pitch from other guys.
Okay, is it because what's the attrition rate in the sense that, because if you said the community is so small, right? So in a way, if there is an attrition from one fund house, it's virtually just people hopping around and just cycling.
Yeah, just recycling. And every time you hop, you get around 20-30% pay increase. So now understand why there's all this hopping around.
Wow. So right, is it? It's not that merit based. Am I right to say that it's not entirely merit based?
I think the unfortunate part about the analyst industry in Malaysia is that, see, you have a lot of people going into the industry simply because they are more attracted to the pay. It's not because of their passion that I want to do research. I love doing research. I want to understand how things works. It's not. So you see, when I interview, a lot of people say, why do I actually want to be an analyst? No, they like the glamour of it. No, I'm an analyst, right? I get to meet CEOs, I get to hang out with CEOs, right? I get good pays. So actually, that's the motivation, unfortunately, right, of a lot of people going to analysts.
Thank you for that.
So, capitalism being capitalism, right? If you don't put up valuable things in the market, you don't get a good pay, right? So,
in the land of the blind, one eye man is the king.
Oh man, I love that.
Okay.
Is it okay? This is actually something that I'm very passionate about, because I'm from outside of the industry, and being in this podcast, I think one of the reasons why we created was actually to level the playing field. And the struggle is that most people, now that you mentioned, it's very difficult to get into the industry. The struggle is that a lot of incentivization structure does not favor the guy on the ground. When I said, I think you know what I mean. The second thing is that there is a lack of proliferation. Like if you go to the US or at other mature markets, it's much easier or less friction for someone to start a fund. Do you see that as a stifling mechanism here, especially with the SC and all that? To someone someone who is pretty good at analysis, but he's not from the industry, he's not from the inner circle, who wants to start something. You think policies can help change that from your point of view?
I think if you really think about it, I think the challenge is, Securities Commission's objective is actually to protect the retailers or to protect the less informed from being manipulated or being used. So that is where the position that they actually come. That's why, whether like it or not, Malaysia is actually one of the very highly regulated in terms of the securities industry. In that sense, is it right or is it wrong? Well, I will guess it's tough. So, to me, my take is this, right? I think you're totally right. Unfortunately, a lot of retailers are being played with to a certain extent, or they're at the shorter end of the stick.
Yeah.
Right? I think what can really help the industry, of course, if there are more courses for them, or there are more avenues for them to actually gain the right attitude, the right mindset, and the right knowledge. I think rather than just clamping down, I think what SC can do is more on the more friendly framework licensing.
Yeah.
Right. So if you look at currently at this moment, right, to actually get the investment or set a company with investment advisory license, you look at the amount of requirements.
Yeah, exactly.
We are aware. Yeah.
It's as close to getting an asset management license.
Yeah, exactly.
So I was joking with my friend. I said, hey, but actually I was exploring recently. I said I should get a license. So I look at the requirement. I say, hey, if I take the effort to meet all these things just for investment license, I might as well do all these things to get an asset management license.
Correct. Exactly.
It's a lot.
Yeah.
But then on the other hand, you must also give kudos to the SC. I think recently they actually changed. They actually further liberate the market. They allow the unit financial planners to also advise on stocks.
Great.
Which I think this is actually a very, very good move. That
Great.
actually allows the unit trust or the financial planners, which we already have out there, to actually let them play an additional role to actually educate the market.
Great.
So on one hand, yes, this part of the licensing, they're still very strict. But on one hand, we also give credit to them that they're actually starting, can see them liberating the market.
Great.
Which is actually would be very, very good for retail investors.
Yeah.
Right.
Yeah.
So-
thanks for that.
So is that, now let's talk about Trident Analytics, right? Is that one of the missions for Trident Analytics? What's it all about?
Yeah.
What are your plans for it?
Vision, mission, wow.
Yeah. Corporate values.
No, actually, I accept Trident Analytics without having much idea what to do with it. No, honestly.
Okay,
I
okay.
set it up, right? So
It's an experiment or something? Was it an experiment?
you can say it's an experiment, just exploration of what to do. So everything happened in January, right? So I still remember it was in the middle of January. One of my colleagues was saying, "Hey, actually, I think it was quite funny, right?" They say, which artist was it? It's Eminem.
Eminem, yeah, the rapper,
the
yeah.
rapper.
I think he launched a video in January. I think within 1-2 hours, it garners 2 million views.
Okay.
So my colleague was telling me, hey, because that time was the MCO.
Yeah.
So because no choice, right?
Yeah.
You have to view on the screen. Say,
Yeah.
why not you do something online? Because it's a good opportunity.
Yeah.
So in just 2 weeks, I said, okay, why not we do a market outlook in 2 weeks? Without proper planning. So even when I was doing the market outlook, when people ask me, so what's the plan of Trident? I said, I don't know. I have no business model for it. I don't know what to do with it, right?
Yeah.
But it was the night before the market outlook. Then something actually struck me. I said, hey, look, what is actually missing from the market, right? It's actually market outlook sessions. Because we don't talk about stocks. I don't talk about stocks. But what I talk about is what is happening in the market that affects globally. What's happening globally that can affect the market. What are the implications and how investors should be aware. So it's really a knowledge-based sharing.
Great.
I have it every last Sunday of the month. So that I can really know what happened in that month to actually comment about it. See, it's something I've forgotten quite a while, right? Because I also forgotten that I do market outlook very often previously.
But under the purview of the fund that you manage or something, right?
I was until 2000 before I became CEO of Interpacific, because during RHB we were still bank, so we got a lot of connection with all the banks, right? So
I see.
was constantly quite constantly being what's the word? Being asked by other banks to actually give market outlook, but it's really to their what do you call it? Privileged clients or
The private banking clients,
those
high net worth,
high net worth, right? So what got me thinking, but it's something that the public don't have access to. So that prompted me to actually create this. But then again, I recognize the fact this is a very niche market. Because I don't talk about stocks.
But especially most people who, because it's quite funny that you say it's market outlook, because most of the time people, the brokerage, right, when they say market outlook, is actually talking about stocks. The free market outlook, you go, so
No,
yeah.
No, I don't want the responsibility to actually talk about
No, fully aligned to that, yeah.
Right. So, okay, so now your charity.
Yeah.
All right. How's it doing?
Yeah, describe to us. It's why were you so enamored to it, and what do you feel that the impact that you're making with this charity actually?
Generally, there's two branch of the charity that I'm doing. I'm with this registered organization called Kriya Lakshmi Mandir.
Okay.
Basically, one of the branches actually we're doing spiritual classes.
Okay.
For the communities.
Okay.
Right? As a main reply, so we're actually based in Ipanas. So we actually conduct classes, spiritual classes, and even tuition classes.
I see.
For the underserved communities. The other branch is we do outreach projects, right? I mean, we have various type of categories. Like we have churches, we have even some of
Is it faith based or non-faith based?
No, non-faith based.
I see.
We have outreach program. Like take for instance, last year, right, during the MCO, right, we got a lot of people requesting. Last MCO was the MCO last year was actually creating the divergence further between the have and the have-nots. You notice whoever have rich invest in the stock market, actually became much richer.
Yes.
But the daily wage earners, like your taxi drivers, they were really, really badly hit.
Yeah.
So we got approached by quite a lot last year. In fact, last year we actually my master, we actually the founder of this school.
Yeah.
We actually created a project, right? We call it From a Mother project,
Okay.
where we actually buy provisions worth 250 ringgit per family. And we actually, you call us, then we actually interview them, we get their details, we get them to collect. And last year we actually distributed close to 1,200
Families.
to families.
Nice.
Yeah. So these
Well done.
outreach projects, right? And there are sometimes even old folks home, they come say, MCO, we don't have food. So we go there and do a survey investigation to make sure that this is legit.
Do your due diligence first,
then we actually will raise funds and then we actually buy provisions for them.
I see.
Right.
That's why there's two branch of it. One is the social outreach project. The other one is actually the spiritual school of it.
So I think I can understand the outreach one a little bit clearer. I mean, it's 250. And by the way, like what does 250 means actually?
What can you buy
to these families?
Yeah.
You can buy actually a pack of 10 kilo rice. You can get flours. You can get the canned food, canned beans, right? You can get 2 packs of beehoons. You can get 5 kg of cooking oils. You can get 5 packs of instant noodles. So the whole thing design is to last them for a month.
Okay.
Yeah. So cook at home for a month, right?
Yeah,
So
yeah.
something flour, all these things for them to last it for a month.
I see.
Right. Interesting. Okay, so then how about the spirituality? Why is that important?
See, spirituality is there's two aspects of it, right? So I always say we are spiritual, but we are not religious. Because see, spirituality is about knowing the greater good of yourself, about realizing what is your true inner self of it.
Right.
Religion is trying to define which higher power is that.
Right.
Right. So we are more spiritual. No, we are not spiritual. We are more focusing on spiritual
Rather
in a
than
sense, in the sense of self-realization about the good in humanity,
Right.
rather than trying to define who is that higher power that is spreading that message.
I understand.
So we are more on the spiritual branch, and we are not so much on the religion branch.
I understand.
So these are people, or you give classes to young children,
Yes.
or is that right?
We have a children. It all ranges from 7 years old all the way to college students. Quite equally spread. I think we have close to 50, close to 60 of the students.
Right.
And we're actually very strict. Everything is free. We don't charge anything, but we have full attendance system.
Wow. So it's run like a school, but it's
Yes.
it's run like it's non-profit. And then what are the criteria? I mean, do you do due diligence on the family backgrounds before you allow them to come?
No, we are quite open, but we have our process. Like for instance, they have to apply in.
Okay.
Once we accept them in, there's a 3 months probation.
Okay.
Then after 3 months probation, then we ask them to attend class
Okay.
for another 3 months probation. Only then after 6 months, then they'll be actually be enrolled into our student.
I see.
But there's no other requirement. There's no.
I see. I
But
see.
we also kick people very fast, right? If they fail to come to class for 2 times without any valid reasons, out they go.
I see. And it's academic subjects like math.
Okay, two parts of it. One
Okay.
is a spiritual. Spiritual is we talk about generally anything that has good human values.
Okay.
Regardless of from which religion.
Right.
So regardless of faith. Okay.
Regardless of faith in that sense, right? The other aspect is we focus on 4 core subjects. It's a BMBI, Maths and Science.
I see.
In addition, we also introduce traditional dance.
Wow.
And also traditional music instruments like your tabla and the harmonium.
Oh, you play?
I I don't.
Aiyo.
Aiyo.
Must lead by
No,
example.
I'm the maintenance guy. Yeah,
If the string patah, then you go.
oh no, not that. I'm not. I'm more of fixing the wiring, fixing the plumbing.
Okay.
But joke aside, I'm actually playing the role of a secretary there. So
I
I
see.
take care of the school.
I see.
Right. So in terms, I have two questions, right? Why do you make the distinction between the spirituality and then the faith-based thing? What are the advantages, assuming that there is? The second one is, what are some of the impacts that you've seen in the lives of these children over the, how many years has it been now running the school?
10 years.
10 years. Yeah. What is there transformation? What has changed in their lives?
You see, why I make that definition of spirituality is my master, which she will always say that, right? There's only one religion in the world,
Right.
which is love.
Right.
Mm.
So that's why we are not trying to go into what religion we are in.
Yeah.
As long as our main purpose is actually love and also a service to humanity and also self-realization at the end of the day. Which comes to the second point. Actually, the most changes is actually not on the children itself. The biggest change is actually on myself. When I start to see your own transformation and
see.
your own progress in terms of thinking, that's where the jewel is.
I
So
see.
a lot of people go into service thinking that I'm going to service, why? I'm going to make their life better. I'm going to change their life.
Right.
I'm going to improve the society. But what they really fail to understand, these are all tools or events that in the end actually benefits or it changes themselves to be a better human.
So it's actually selfish.
In
It's
that
selfish
sense,
for a good reason.
It's not to say selfish. If I rephrase it, it's like it's an individual journey.
Yeah, I understand. I mean, selfish in a good way, in a way that you go out to help, but in a way you learn more for yourself actually.
You see, my master always said this. You see, when a lot of people go for do service, they call it do service.
Do
Right?
service, yeah.
They do service, they assume they're doing external service. They go out, I sweep the floor, I mop, okay, I pack, I go back, right? But my master always say that what people always fail to realize, in the act of doing that service, what you should be gaining is your own self-realization, your own self-awareness, right? But people always focus on the external act of the service, which actually we call it yoga. Yoga is actually action. No, not that stretching hand, but actually the whole term of yoga is actually action. Right? So my master always teach is Kriya Yoga.
Okay.
To a certain end, it's an inner action. So how do you internalize your external action to internalize within yourself and to gain realization within that?
Understand.
Right. And so that process of service, so to speak, is this Kriya Yoga that you're talking about.
Right.
So, you say that you've gained a lot more from these acts of service as a result, right? And what are some of the jewels that you've learned, throughout these 10 years?
See, I let's say about on a very fundamental level, right? I'm definitely, if you look at it, 10 years ago, I'm quite impatient, right? I'm quite rude. I'm not where I am today, right? It's due to those refinement. Right? I'm not perfect yet. I'm still far from perfect.
Right.
But you can see that changes. So I said that the biggest miracle I've seen is my own changes. Because if you know me previously, it's not easy to change me. Right? Many people try and fail.
Okay.
So the miracle I see is actually my own changes.
I see.
Which to me, it's really not easy to change me to be where I am today.
I see. So less rude, less impatient right now.
Still brutally honest.
It's fine with us.
Well, who say that's a bad thing?
Yeah, it's a good thing actually.
So it's how long has this podcast been? So almost 2 hours. This will be the longest podcast. I just have one small question left, which is that I think what's interesting about you is that you're so into spirituality, which is the last thing you would think that a fund manager, a money manager would be involved.
Exactly. Yeah.
Right? And how they are almost polar opposites. Right? So like a wealthy Buddha,
Because
like,
in Wall Street or investment banking, it's all about
it's all about numbers,
about
it's all
access.
about
It's about
result.
access as well, right?
Being excessive. And I mentioned earlier on the podcast that you drive your scooter to work, you donate a huge chunk of your salary to the
Remember
cause.
the book? So if those of you who don't know, the book, all the proceeds of his book actually goes
to this charity.
Yeah,
right?
exactly.
So why do you decide to why do you decide to start this thing? Right. So I've learned about how you've transformed yourself in these 10 years. But at a point in time 10 years ago, why start it when you could be just enjoying all your rewards as an analyst and a fund manager?
Okay, you really think about it, right? Whether you're analyst or a fund manager, you're a salaried employee. So I think I already hinted in my book, right? If you do things the right way, right? If you're a proper analyst or proper fund manager, you can lead a comfortable life, but you won't be very rich. So just the perception of being an analyst fund can make you very, very rich.
It's not entirely true lah.
It's not true if you do things the right way.
There's the insight.
You can be comfortable, right? I mean, okay, say for instance, if you're a 15-year fund manager, right? I think your average salary per month is around 15,000, 20,000.
Okay.
It's comfortable.
Yeah.
But you can't buy a Porsche.
Yeah.
You can't buy a Maserati.
Yeah.
But yet you're seeing some people have Porsche and Maserati, so please don't ask me how they get the money. I won't comment on that, right? But see, sometimes in life we all face challenges. So of course that time I was quite facing my life challenges, right? So sometimes you see people say life challenges are given to you so that you go back and seek God, which is actually true. When everybody's doing well, right, nobody will actually, they think they're the king of the world.
Correct.
They will think they themselves.
Right.
Yeah.
It's during the time where you face the challenges in your life.
Correct.
Where you start to find answers or find solutions to it.
Yeah.
That's why you get more connected to it. So I guess that's where I was 10 years ago. Right?
I see.
So I get connected because I was facing my own challenges in life at that time.
I see. Yeah.
I mean, if it's too private, don't do it. But what was that challenge that you overcome through this process?
That time was like everything that went wrong. Or everything can go wrong went wrong, right?
In career, in life.
Career, in life, everything was wrong.
I see.
Right.
I see.
Okay, man. Peter, thank you so much. This will be you shy of.
No,
2 hours?
don't
you got a
worry.
question?
This
Okay.
2 minutes. No
Yeah,
question.
you got a
It's more of a his shout out and his how
How
can,
people can find you? You know?
how can people find you?
I have my Facebook.
Okay.
Peter Lim. That's my Facebook. I also have my own website.
Okay.
www.trident-analytics.com.
So you heard it. Trident-analytics. Trident meaning the trident.
Yeah.
So I mean, I do know it is a paid product. So we want to share with people how they can, if they want to be part of Trident Analytics, what they will have to go through.
Okay. Basically, we only have one service, which is of course the monthly market outlook.
Okay.
If there's a pay-per-view, which is on a monthly basis, and there's of course a 12-session subscription.
Okay.
So on the pay-per-view basis, it's 216 per session.
Okay.
On the pay-per-view is 2088 for her. So which I think work out around 170 plus. I didn't come with the pricing.
Okay.
My colleague come with the
Okay.
pricing.
All right. Yeah. So it's cheaper for the annual subscription, put it this way.
It is cheaper.
Yeah.
I said this is very niche. I mean, I always joke, right? I can never imagine people actually paying money to listen to me talk.
But people do want to hear you talk. Yeah. The other thing is about your book. So where can they get access to
You
your
can
book?
get it in most major bookstores. I mean, there's Gilcunia, MPH, Popular. You can also get it from Trident website.
Okay.
Which is
So
available.
it will be delivered to their homes if they order.
Yeah,
Okay.
And the full name is What I Learned as an Analyst.
Yep.
Correct?
Yes.
And there's a second edition now.
The second edition, and the second edition is available also in Bahasa and Mandarin.
Okay.
Okay.
Any ebooks or is purely a hard copy?
There's ebooks available in all platforms, even iBook, except for Google. Because apparently my distributor for ebook is not on good terms with Google.
I see.
So the price, I remember the prices are a bit different for each languages. Is that right?
Yes, for the English is $50 ringgit to be more exact. I think for Mandarin is 44.50. Bahasa is 39.90. Again, I didn't set the price. It's just set by
Why is there discrimination for? No, just kidding.
Yeah.
I didn't set the price.
All right. Okay. So and guys, remember that all proceeds go to the foundation or the charity organization, right? But before that, because I want to hit 2 hours, right? So I need to ask a question. No, but it like why should I know why I got your book, right? But why do you think people should get your book?
Yeah,
and
that's a
why
good
is your
question.
book different?
Yeah.
I think the whole intention of a book is I totally avoid talking about myself. So there's really no telling you, oh, I did this right, I did that right. I think that really doesn't serve the purpose.
Understand.
So the whole book is really more of guiding investors, right? How do you actually look at companies? How do you look at the income statement? How do you actually talk about valuation? What's the common valuation methodologies? What are the common pitfalls, right? So it's totally me out of the picture. So the whole book is totally nothing about me, because you do see quite unfortunately a lot of investment book about self-glorification, right? I do this right, I do that right.
Yeah.
But no, every investment is different.
Yeah.
What you get right for this investment, you can't repeat it for the other investment. Right?
Yeah,
so there's no
exactly.
point talking about what I did right, which I think it actually adds more value for for readers to actually look at things on a very more basic level.
Yeah.
On what they need to know to be able to invest in the market.
Yeah.
Well, Peter, it's been a pleasure. Hope to have you back for a second podcast if you want.
Yes.
And guys,
If
this
nobody
is-
troll me on my website.
Oh, no worry. So whatever we said, his website and everything, we'll leave the links in the comment
Yeah,
section
yeah.
below, so you guys can link it. Yeah.
Yeah, and guys, hope you guys thoroughly enjoyed this podcast. Look forward to more podcasts like this in the future. Look forward to Peter coming on in the future as well. You guys have a good one, and see you in the next podcast.
All right,
See you guys.
Thank
you.
you guys. Thanks for having me here.
Thank you.
Okay.